Hello and welcome to Session 17 of the Basic Tax course. We're going to begin Session 17 with a review of the Sessions 15 and 16 quiz answer key. And as you recall, Session 15 and 16 were both devoted to the topic of depreciation and amortization, a fairly lengthy topic, which is why we've broken it up into two sessions, but also a crucially important one. It's pretty difficult to do any kind of tax return that includes a rental property or a business without having some knowledge of depreciation. And so we use these two sessions to really give you a good solid foundation. And now the quizzes, of course, or the quiz is designed to help solidify some of those concepts covered in sessions 15 and 16 with respect to depreciation. Let's begin with a review of question number 1. Real property includes which of the following? As soon as you hear the word real, you should be thinking of real estate. It's kind of a dead giveaway. And which of the assets listed is real estate? Obviously, a car, a photocopier, and your home computer are not real estate, and clearly most homes sit on land and are considered to be real estate. So real property does include your home, and that's why A is the correct answer. Moving on, question number 8 is the next one we're going to take a look at. It says all of the following assets are 5-year property under makers except, and the answer is, well, it's actually cell phone. Both a car and a computer are specifically listed with asset class lives of 5 years. And you should remember that from looking at the asset classification tables in the back of publication 946. But if you examine publication 946 in depth on those asset classification tables, nowhere in there does it list cell phones. And what the publication does say is that if there is no classification for a particular asset, in other words, the asset is not classified, then it defaults to 7 years. And so the cell phone is clearly not classified as 5-year property, and therefore it defaults to 7-year property. Ironically, of course, most cell phones are lucky to last 2 years and really should be classified, if they ever were classified, as 2 or 3-year property, yet they just are simply not classified at all. Question number 14 is next. Maker's 200% declining balance applies to which of the following property not held for farming only? Well, 200% declining balance is essentially the method that we looked at where you claim 20% depreciation in the first year, 32% depreciation in the second year, or you could say you're looking at 200% of the normal amount of depreciation allowed under the straight line method. And of course, when I was talking 20% in the first year and 32% in the second year, I'm talking about 5-year property. 5-year property, if you were to depreciate it straight line, you would get 20% a year. But after you apply the mid-month or the half-year convention, you only get half of that, 10%. But if you are claiming double declining balance, then you are allowed double the normal amount of depreciation allowed in that first year, which would be 2 times 10% or 20%. And so you basically look at the types of assets that are eligible for that 200% declining balance. Only the 5-year property gives you that perfect number of 20%. Obviously, 3- and 7-year property come up with a different ratio. But all of those properties, 3, 5, and 7-year, are eligible for 200% declining balance. In certain situations, 10-year property not used in farming is also eligible for 200% declining balance. So we have a little note about that on the side. But when you're looking at this particular question, 200% declining balance applies to which of the following not held for farming? Well, clearly 7-year property is allowed, and both 3- and 5-year property are allowed. And really, to say that only 3, 5, and 7 is allowed is not correct. And so that leaves us with A, that 3, 5, and 7-year property are all eligible. Moving on to question number 16. In 2012, you sold a desk for which you previously elected to claim a Section 179 deduction. You figure your recapture amount by which of the following? And so then we give you basically 4 different options to look at. Now, when you're looking at the sale of an asset, you're going to have to look at the recovery or recapture rules on depreciation. And when you sell an asset that depreciation has been claimed against, the first portion of the gain you look to is what portion of the gain is due to that previously claimed depreciation. And it doesn't really matter whether you claimed a Section 179 deduction, whether you claimed bonus depreciation, whether you claim straight line depreciation. What we look to see is whether any of the gain being taxed is attributable to depreciation at all. And in this case, Since we claimed a Section 179 deduction, we know that the original acquisition cost of that asset is being fully recovered, or at least partially recovered, on the sale, depending on the sales price. We don't tell you the sales price, and that's really not relevant, because what the formula is what is relevant, and the formula is that if you sell an asset where depreciation was claimed, look to see how much of the gain on the sale of that asset is due to recovered depreciation. And anything up to the original basis of the asset that has been depreciated is going to be called recapture depreciation. And anything in excess of that is going to be capital gain. So let's read through the selected options here and see which one most closely fits. A, figure the difference between straight-line depreciation and Section 179 deduction claims. The difference is reported as capital gain income. Well, that's not it. We're not telling you, there is no rule that says look for the difference between Section 179 and straight line. There is a rule that allows for that computation, but it has to do with recapture of the Section 179 deduction when an asset is converted from business use to personal use. But that's not what this problem is about. We haven't converted an asset from business use to personal use. We've sold an asset. Number B, figuring the difference between straight-line depreciation and the Section 179 deduction claims. The difference is reported as ordinary income. Well, again, if this were a conversion of business property to personal property or personal use property, that would be the correct answer, but that is not the situation we're looking at here. C, figuring the amount of gain realized upon disposition of the asset that is due to previously allowed or allowable depreciation, Section 179 deduction, or special depreciation allowance, and reporting this gain as ordinary income. Well, as I've already explained, this is the correct answer. I basically specified it twice before we started even reading the answers, and this is it. And then finally, D, figuring the difference between double declining balance depreciation and the Section 179 deduction claim. The difference is reported as ordinary income. That particular rule isn't applied anywhere that I can think of. So let's move on now to the next problem in line, and that's the mini problem. Joe's Heating and Air Conditioning is a home-based business. Business profits paid prior to any deductions for depreciation totaled $50,000. Joe purchased and placed in service the following assets for the year. You can see that there's a laptop computer, a generator, and a Dodge Caravan. The date placed in service is shown for each asset. And the first relevant thing I'm looking for when I look at these dates placed in service is that they are all in the first 3 quarters of the year. There's nothing placed in service in the final quarter of the year, so we know right away that the mid-quarter convention shall not apply, and we're going to be looking at the half-year convention on all of these assets. We then look to the asset description. We can see a laptop computer. Laptop computer, pretty much by definition, as far as I'm concerned, is a listed property. That means this asset will need to be reported in Part 5 of Form 4562. The generator at 7-year property is going to be depreciated, and that is reported in Part 3 of 4562. And the Dodge Caravan is, of course, another form of listed property, which is reported in Part 5. We also notice here that the Dodge Caravan is 85% business use, and then I give you some more information. The maximum auto depreciation in 2012 is $3,160, but do not claim the special depreciation allowance. So what we're looking at here then is that the maximum amount of depreciation allowed on this Dodge Caravan will be $3,160. It's 85% business use. So the maximum depreciation deduction we can claim for the Dodge is going to be 85% of $3,160. Further, Joe wants to depreciate the generator and the van, and he would like to expense the computer. So we're going to claim a Section 179 deduction for the computer in Part 5. We're going to claim regular depreciation for the generator in Part 3, and we're going to claim as much depreciation as we possibly can, given the limits on automobiles, in Part 5. And then we throw in the depreciation tables here for you for the 5- and 7-year assets so that you can work your way through it. Well, let's go over to the answer key now. Let's go over the answer key now and take a look at Form 4562. And of course, when we're dealing with 4562, it's one of those forms that you really need to fill out page 2 first. So let's begin with page 2. And on page 2, we're obviously going to need to list the assets that are listed property. And we have the computer and the Dodge Caravan. Both were used more than 50% in a qualified business. We list the date placed in service, the business use percentage, the acquisition cost or the cost basis of the property. And then in the case of the Dodge Caravan, we're going to show the basis for depreciation as $21,250. That is 85% of $25,000. The basis for depreciation on the computer is 0, and the reason is that we're claiming a Section 179 deduction, and that reduces the basis down to 0, so there is no depreciable basis left. The recovery period on the van is 5 years. We're going to try and claim 200% declining balance, but we're not going to be allowed anywhere near 20% of $21,250 in the first year. Again, we're going to be limited to $3,160 multiplied by 85%. And then we move over to page 1. And on page 1, we carry over information that appears in Part 5. And on line 7, we show the listed property from Part 5, and that is $1,200 for the laptop computer. You'll see up on line 2 that we have to make an entry for the total cost of Section 179 property placed in service during the year. And earlier in the answer key, we do show you how that computation comes to be. We take a look at the van. 25,000 times 85% is 21,250. We add in the laptop, we add in the generator, total those three assets up, and we have 23,250. And then we take that number and wonk it down here on line 2. Next, we take a look at the generator. The generator is 7-year property, $800 acquisition cost, half-year convention, 200% declining balance. The depreciation we get is $114. And of course, in the wording of the problem, we did provide you with the maker's depreciation table. For 7-year property, the first year of depreciation is going to be 14.29%. So you take 0.1429, multiply that by $800, and you get $114. The last step is to add these numbers up. We have 1,200, we have 114, and then look over here. Remember that depreciation deduction from Part 5 on the van, 2686 carries to line 21. We add those numbers up, and that makes line 22 $4,000. So that completes the review of the Session 15 and 16 quiz answer key, and let's move on now with the Session 17 lecture. So good morning, everyone, and welcome to Pacific Northwest Tax School's course called Sale of Assets. This is actually our most popular course. It always has lots of enrollments, lots of interested people. Interestingly enough, here in Oregon, we have a consultant exam, and on the consultant exam, sale of assets weighs very heavily, and it is often a confusing topic. Statistically, we see that people have trouble with this particular topic in the consultant exam, so I expect that's why it's such a popular course of ours. And today we're going to be looking at sale of assets really in two separate parts. One part we're going to be looking at sale of capital assets, stocks and bonds, maybe some land you own, and how that is treated on your tax return. Also, we'll look at holding period and identifying stock sales or asset sales as either short-term or long-term. And when we're done with that segment, we're going to take a look at the sale of assets that have been used in a business, depreciable assets used in a business. How is the sale of those assets treated? And so that is a short summary of what we're talking about today. In the reading for this course today, I've pulled information from two main sources, IRS Publication 17 and also IRS Publication 5.4, but I've also utilized other resources that you may see me mentioning throughout the class. So we'll start at the top of page 2 of the manual with this introduction. Different rules apply to the sale of capital and non-capital assets, and gains and losses on the disposition of personal investment property are taxed differently than the gains and losses on the sale of business property. This course covers the reporting requirements for dispositions of capital assets that are reported on Schedule D, and it also provides a close-up look of how to report dispositions of business use assets on Form 4797. And not mentioned in that paragraph is also the fact, of course, when you're selling personal assets, capital assets, those also need to be reported on Form 8949 and then to Schedule D. And with 4797, you may or may not need to carry a number to Schedule D. We're going to begin with a few terms that you need to know in this realm of sale of assets that is under the category of sales and trades. In order to calculate whether you have a taxable sale, you must first determine the nature of the property you are selling and whether you have a gain or a loss. In general, you do not need to report the sale of personal property that you sell at a loss, and this is because the loss is not deductible to you. However, if you sell your personal property at a profit, or if you sold investment property, then you do need to report your sale. A sale is generally a transfer of property for money or a promise to pay money in the form of a mortgage or note. A trade, by contrast, is a transfer of property for other property. We think of trade really in the business world, it might be barter, but if you have a lawnmower and you want to trade it for someone's bicycle, that would be a trade, as opposed to a sale where you might sell your lawnmower and then use the money to buy a bicycle. If you sell property for money and then you immediately use that money to purchase replacement property, you do not have a trade. Capital gains and losses. Generally, you will have a capital gain or loss if you sell or exchange a capital asset. You may also have a capital gain if you sell a Section 1231 business asset at a gain. And Section 1231 property is property used in a trade or business for more than a year that is not inventory. We also need to look to the character of gain or loss. You will need to classify your gains and losses as either ordinary or capital. And ordinary gains result from the sale of non-capital assets, such as property held mainly for sale to customers. We call this inventory or stock in trade. Also, depreciable property used in your trade or business. If you sell real property used in your trade or business, that too is ordinary income property. Also, a copyright, literary, musical, or artistic composition, a letter or memorandum, or similar property such as drafts of speeches, recordings, transcripts, manuscripts, drawings, or photographs that were either created by your personal efforts or prepared or produced for you, in the case of a letter, memorandum, or similar property, or received from a person who created the property or for whom that property was prepared under circumstances, example by gift, that entitle you to the basis of the person who created the property or for whom it was prepared or produced. And essentially what that means is the IRS is saying that if you create something out of your own physical work, that is not a capital asset to you. So if you're an artist and you paint a painting, that asset to you is not a capital asset. And if you sell it, that would produce ordinary income rather than capital gain income. It's also saying that if you create that painting and then you gift it to someone, they're going to have the same type of income from selling it that you would in most cases. In other words, your basis in it would transfer to them. Note, however, there is a special rule here. It's relatively recent. I don't remember when it came into play, but this is the rule for this specific group. You can elect to treat musical compositions and copyrights in musical works as capital assets when you sell or exchange them if your personal efforts created the property or you acquired the property under circumstances, for example by gift again, that entitle you to the basis of the person who created the property or for whom it was prepared or produced. Now, if you want to take advantage of this particular rule that affects only the creators of musical compositions and copyrights in musical works, you must make a separate election for each musical composition or copyright in a musical work that was sold or exchanged during the year. You then must make the election on or before the due date, including extensions of the income tax return for the year of the sale or exchange. You also must make the election on Schedule D and Form 8949. You can't do D without the 8949 anymore. By treating the sale or exchange as the sale or exchange of a capital asset according to the Schedule D and its instructions. So, of course, if you have an asset that you created because you're a musical composer, you've written a musical piece, and you sell those, and you're well known for that, so you create musical pieces and you sell them. Typically, that would be recorded by you as self-employment income. But the IRS says that if you have a musical piece and you sell it, and you wish to receive capital gain treatment instead of ordinary income treatment, that rather than including it in income on Schedule C, you would instead report it on Form 8949. That's an interesting exception for one very specific group. Also, what is considered to be an ordinary income type of property are accounts or notes receivable. And finally, ordinary income property also includes supplies of a type that you regularly use or consume in the ordinary course of your trade or business. When you sell ordinary income property, you have not sold a capital asset per se, although some types of ordinary income property can produce a capital gain in the long run. they're classified differently than other types of capital assets. And the distinction is important because when you sell an asset that is not a capital asset, the sale of that asset is either reported as ordinary income, usually in the business receipts of your business, or it's reported as a sale through Form 4797. Capital assets, by contrast, or capital gains, result from the sale of your personal assets or investments. And these types of assets include things like stocks or bonds held in your personal account, a house owned and used by you and your family, household furnishings, a car used for pleasure or commuting, coin or stamp collections, gems and jewelry, gold, silver, or any other metal. And finally, including, interestingly, timber grown on your home property or investment property, even if you make casual sales of the timber. Now, the location of our school and where I'm sitting today is Portland, Oregon. We're in the middle of the Pacific Northwest, and we have lots of trees around here. So we get a few people in our office each year who sell timber. And timber, I have seen more than one occasion where people have mistakenly thought that the sale of timber on their land would result in some form of ordinary income, like farming income, and they would report the sale of timber that they cut on their land on their tax return as farming income. And the IRS says no. Unless you're actually a commercial timber company in the business of growing and or harvesting commercial timber, that timber for a typical landowner is really a capital asset. And if you go out there and cut it all down and sell it, you would actually have the sale of a capital asset, and that would be reported on Form 8949. Holding period. If you sold or traded investment property, you must determine your holding period for the property. Your holding period determines whether any capital gain or loss was short-term or long-term as follows. Short-term includes investment property that was held for 1 year or less, and long-term is investment property that was held for more than 1 year. It's an important distinction here because you only have long-term when it's more than a year. 1 year is not long-term. More than 1 year is. To determine how long you held investment property, begin counting on the date after the date you acquired the property. The day you dispose of the property is a part of your holding period. So here is an illustration of holding period. You bought an asset on June 18, 2011. You start counting the next day, which is June 19, 2011. If you sell the asset on June 18, 2012, your holding period is 1 year. It is not longer than 1 year. And so it would be a short-term capital sale. Now, if you sold the asset on June 19, however, of 2012, then your holding period would in fact be more than 1 year. For securities traded on established markets, if you bought or sold through the stock market, your holding period begins the day after the trade date that you bought the securities and ends on the trade date that you sold them. Note, however, that you should not confuse trade date with settlement date, which is the date by which the stock must be delivered and payment must be made. You should report any gain or loss in 2012 for any sale with a trade date ending in 2012, even if the settlement date for the sale was at the beginning of 2013. For stock dividends, if you received taxable dividends in the form of stock, essentially a dividend reinvestment, your holding period begins on the date of the dividend distribution. If you received non-taxable dividends in the form of a stock split or spin-off, your holding period is the same as for the original stock. So let's look at an example here. You have stock in AT&T, and on June 10th, 2011, AT&T gives you a $10 dividend. And you use that $10 dividend to purchase a partial share or another share in AT&T. Your holding period for that reinvested dividend would be the date that it was issued and reinvested, which would be January 10, 2011. By contrast, let's just suppose you have some stock in AT&T, and AT&T decides to split off. And in fact, that's what happened with AT&T back in the 80s and again in the 90s. It went through a bunch of spin-offs. One of the spin-offs was to create the Baby Bells, as they're called, or were called back then. And another spin-off that occurred in the mid-90s, I believe, was Lucent Technologies. And I don't think Lucent did too well. But at any rate, that was a big spin-off that occurred from AT&T in the 90s. And I remember dealing with lots of people who had shares in AT&T who then got shares in Lucent, and I don't remember the exact ratio anymore, but let's just suppose that 1/3 of the value of the stock went to Lucent, and the other 2/3 of the original cost in the stock remained with AT&T. So as a result of a spinoff, you're going to have shares in two different companies, and you're going to have to split your cost basis in your original shares between the original shares and the new shares that you're receiving. And stock splits work similarly. With the stock split, you might start the day with one share, and at the end of the day, you have two shares without having bought any more shares. That's what a split is. Sometimes you'll have a 2-for-1 split, sometimes a 4-for-1 split. When the stock market is really doing well and there's growth in companies, stock splits are quite common, and lately, because of the recession we're just nicely coming out of now, there hasn't been a lot of stock splits going on. But a stock split essentially serves to double or triple the number of shares you have, but it also cuts in half your basis per share. Non-taxable trades. If you received property in a trade, your holding period for the new property begins on the day after you originally acquired the old property that you traded away. And property received as a gift. Your holding period for property you receive as a gift depends on your basis. If your basis is the giver's adjusted basis, then your holding period starts on the same day as the giver's holding period began. And if your basis is the fair market value, your holding period starts the day after the date of the gift. Inherited property. If you inherited property, your holding period is always long-term. When reporting the sale of inherited property, you should write inherit on Form 8949 or Form 4797 as the acquisition date. Now, one of the things I can comment on with inherited stock is frequently when I get the 1099-B brokerage statement, that brokerage statement indicates the acquisition date of the decedent. So when the decedent purchased the stock, that's the date shown on the brokerage statement. But if the stock is now held by a person who inherited that stock, either the estate or a beneficiary to whom the rights to ownership of that stock have passed through, it's important to have a discussion with your client about how they acquired the stock, and if they say that they inherited the stock, then you're going to be looking typically to the fair market value on the date of death of the decedent and going with that valuation rather than the valuation and date of purchase that is shown actually on the 1099-B. How often does this come up? Well, I'd say all the time. In any particular tax season, I'll probably have 2 or 3 clients in a single season who have inherited stock, are showing me a 1099-B that has acquisition date and acquisition purchase price of the stock basically as it was acquired by the decedent. And you have to throw that information out, start fresh, and say, okay, what was the fair market value on the date of death? There's one exception to that rule, and that is that if the estate decided or elected to use a valuation date of 6 months after the date of death, but that rarely happens. It's nearly always the date of death. And by the way, when you do look to the valuation of stock on the date of death, it's not at all hard to do. There's a number of different resources you can go to determine the fair market value on the date of death. One is back to the brokerage house that's currently managing the portfolio and asking them to do valuations. To me, that seems the most logical. They have systems in place, and I have seen well-managed companies able to redetermine basis for an entire portfolio containing many hundreds of different types of stocks very easily. And then I've been in other situations with clients who work with brokerage houses or brokerage firms that seem to be quite inept and not willing or are unable to do that for them. But it's not at all uncommon for me to have to do the work the hard way, and one of the places I like to go for that is bigcharts.com. And I think I'll take it upon myself to show you bigcharts.com for just a second, so let me do that for you. If you've been to bigcharts.com, this is just not going to be terribly exciting for you, but if you are new to the concept of bigcharts.com, this can be helpful. Bigcharts.com is not the only resource out there. It's just one that I happen to have found, and it does for me what I need to do. When you land on bigcharts.com, you have an ability in here to go to historical quotes. And you can see here it's got Microsoft up as an example. And if you want to know what Microsoft traded for back on 6/19 of 08, because it's just defaulted to that, you can see that on that particular day there was a high of 29.19 and a low of 28.33. And by the way, when you're dealing with inherited stock, you would take the high and the low for the day and average them, and that would be your cost basis in inherited stock. And then it has a closing price and an opening price. In this area here, off to the side, you can see my little mouse pointing at it, it says no splits. That's important too, because if you're dealing with stock that's been held for an extended period of time, it could be the case that there have been some splits. Now, bigcharts.com, I believe the farthest back in time it'll go is about 10 years, and if you want to go back farther in time than that, you have to pay. And I don't have a subscription. I don't pay for anything. If I have to go back farther in time than that, I really do put it back on the brokerage house. But also, when you're dealing with major companies like Microsoft or AT&T, you can typically go to their sites and go into shareholder services, and they'll have stock split information in there and cost basis information in there as well. But just as an experiment, let's just type Dell and see what Dell traded for. I'm going to pick a number out of the air on 6/15 of 2005. Just to see what it says. That was a Wednesday, and now I've got the cost basis for Dell stock on that particular day. It's showing up right here, high and the low, and again, it's telling me there are no splits. So back into the manual. How to figure your gain or loss on the sale of property. How to calculate your gain or profit or loss on the sale or trade of property, you must first calculate the following: your adjusted basis in the property and the amount you realized from the sale. So with all sales, of course, to figure a profit, you have to know two things. You have to know your adjusted basis in the property, and you need to know how much money you've gotten from the sale. Quite logical. Adjusted basis in the property you sold. Your adjusted basis is the original cost basis in the property plus and minus certain adjustment items. Today's class is not about basis of assets. We covered that in an earlier course I teach called Basis of Assets. So we're not going to be spending any time today really talking about basis at all. If you're interested in that particular topic, we have 3 hours on that topic alone that you can go learn about, including how to figure cost basis in stock options, employee stock options, as well as assets that you've held that you may have made improvements to or claimed appreciation on. Today we're assuming by the time you've gotten to this course that you understand those basic concepts. The amount you realize from the sale is everything you received for the property, and it includes cash, also mortgages payable to you, mortgages or other debts owed by you and assumed by the buyer, and other property or services you receive in exchange for the property. Seller financing. If you finance the sale of property, the amount you realize is the total of all payments you receive over the lifetime of the loan minus interest. This is because all loans are treated as having two components. The first is interest, and the second is principal. If your loan does not state that a rate of interest applies, then the IRS will apply a minimum rate of interest for you. If you want to know how they set rules for that and how they go about computing their interest, all you need to do is go to the IRS website and do a little bit of research. They certainly have plenty of information in there about how they would go about applying minimum rates of interest where they deem that interest should have been assessed and was not. And here is an illustration of what I mean. We have sales proceeds allocated between principal and interest. You sell your rental home under a contract sale on January 1st of 2011. The sales price is $150,000. The buyer pays you $10,000 down and agrees to pay you the remaining $140,000 within the next 18 months. Then on January 1, 2012, the buyer pays you $140,000. There's no stated interest amount for this transaction. So this is a really simplistic one. Typically, most interest is going to be from an interest schedule or an amortization schedule where you have to add it all up over time. In this illustration, we've created something pretty simple, $10,000 down, $140,000 a year later or 18 months later. But that $140,000 over the 18 months that it's been held, you can't say there was no interest that should have been charged or could not have been assessed on $140,000 for an 18-month period. IRS says there has to be an interest component to that. So even though the interest was not stated, we have to construe that interest was in fact paid when the loan was paid off. And you will need to allocate a portion of the sales proceeds to interest at a fair market rate. If the fair market rate for this transaction is 8% per year, then you must subtract unstated interest from the sales price. In this example, unstated interest would be $140,000 times 8%, or $11,200. Therefore, the true amount realized on the sale is in fact $10,000 plus $128,000, or $138,800, because you're going to have to subtract $11,200 from the remaining balance of $140,000. So how would that look on the tax return? Well, you would report $128,800 of income from the sale of the asset, and you would report $11,200 of interest income. Treatment of capital losses. If your capital losses are more than your capital gains, you can deduct your allowable losses against your taxable income. The yearly limit on the amount of capital loss you can deduct is $3,000, or $1,500 if your filing status is married filing separate. Capital loss carryover. If your net losses are greater than $3,000, you must generally carry your loss forward to the next year. Short-term and long-term losses. When you carry over a loss, it retains its original character as either long-term or short-term. A short-term carryover to the next year is added to short-term losses occurring in that year. A long-term loss carryover to the next year is added to long-term losses occurring in that year. And if you have both short-term and long-term losses, the short-term losses are used first against your allowable capital loss deduction. And if after using your short-term losses you have not reached the limit on the capital loss deduction, you will use your long-term losses until you reach that limit. So here is a fairly detailed illustration of how all of the rules for application of short-term and long-term loss carry-forwards work and are applied on the actual tax return itself. In our illustration, we're starting in the tax year 2010. I'm going to zoom in a little so you can see it on your screen since this is a pretty detailed illustration. I think I've got it on as big as it can be where it's still not going off the edges. So in this illustration, you can see I've got a Schedule D off to the side, and I've got a capital loss carryover worksheet down at the bottom, and we're going to take a look at the problem that's being described. It's tax year 2010, you can see by looking at the form. And in 2010, you had a short-term loss of $6,000 and a long-term loss of $8,000. We're looking at the Schedule D, and you can see in that year we have a $6,000 short-term loss, and we have an $8,000 long-term loss. When you add those two amounts up, you carry the total to line 16 of the Schedule D, and you have $14,000 of loss for the year. Well, we know that the limit on losses, whether they're short-term or long-term, is $3,000. So the most that can be deducted on the 1040 is $3,000. So it's self-evident that if you deduct 3, you're going to deduct 3 from 14, and you will have an $11,000 loss carry forward. But what will be the character of the loss carry forward? Well, the carryover loss worksheet will show you that. And you can see here in this cutout right here, we have the 1040, line 13, we are claiming that $3,000 loss. Line 21 from the Schedule D carries down to line 13. And then we've got this $14,000. We're going to subtract out $3,000, and we're left with a carry forward of 11. But how does the 11 break out? Well, we have to subtract the $3,000 loss that's allowed during the year first from the short-term losses. So if the short-term losses were $6,000, then the $3,000 loss that we're allowed to claim in 2010 is going to be short-term. That means that carry forward for 2010 into 11 will be $3,000 short-term. And on the long-term loss of $8,000, we're not able to use any of that in 2010, and therefore all $8,000 of long-term loss will carry forward to 11. I have a cutout here of a capital loss carry forward worksheet, which is the worksheet that is used to figure the amount of your carry forward. And you can see it starts on line 5 by entering the amount of short-term loss that you have. On line 7, it's saying how much are you claiming this year, 3, and then how much are you carrying forward to 2011, it's 3. And then for the long-term losses, we start with an $8,000 loss. None is allowed in the current year, and all $8,000 is carrying forward to 2011. So let's move on to 2011. In 2011, you report short-term gains of $2,000 and long-term gains of $3,000. Subtract your short-term gain and your short-term loss carryover as follows. So we're going to take the $3,000 carry forward short-term loss, and from that we're going to subtract the 2011 short-term gain. And we have a $1,000 loss. Then we're going to subtract from the long-term gain the long-term loss carryover. So if the long-term gain is $3,000, we have $3,000 that's going to come out of 8, and we have a $5,000 long-term loss. So how is the character going to work? Well, in the current year, we're first going to use the remaining $1,000 of short-term gain, and then we're also going to be allowed to start cutting into our long-term gains, and there would be $2,000 left for that. So again, we're always dealing with the limit, and on the limit, we have $3,000 that can be claimed during the year. And what is the character of that loss? We start the year with a $2,000 gain and a $3,000 short-term carry forward loss. $3,000 minus $2,000 is a $1,000 short-term loss. We have a $5,000 item that is sold with a $2,000 cost that is long-term, giving us a long-term gain of $3,000 in the year, but we have an $8,000 carry forward loss that is long-term. And so you can see here on line 16 that our long-term loss is $5,000. We're going to take the $5,000 on line 15 and add that to the short-term loss on line 7, and we get that $6,000. And we know mentally that of the 6, 3 is going to go right down here to line 13 and get deducted. So we carry it to line 21 and then down to line 13. And going over to our carry forward worksheet, we can see that we have now used up $1,000 of loss carry forward into 2011, that is short term, and we're going to have zero carrying forward to 2012. On the long-term side, we start the year with a $5,000 carry forward. We're going to apply $2,000 of that in 2011, and that leaves us $3,000 carrying forward to 2012. So let's move on to 2012. When we get to 2012, we have a good year. We have short-term gains of $4,000 and long-term gains of $10,000. And what's going to happen? Well, we have no short-term loss carry forward. So even though we have long-term gains of $4,000, we're not going to be able to use our long-term carry forward loss to offset any of the short-term gains. Instead, we're going to use all of our long-term loss carry forward to offset only the long-term gains. The long-term loss carry forward is $3,000, so we're going to subtract that from the current year, 2012, long-term gain, and we're going to end up with a $7,000 gain long-term for 2012 and a $4,000 gain short-term for 2012. So we move over to the Schedule D for 2012. We show $4,000 of short-term gains. We show $7,000 of long-term gain, and all $11,000 is going to be shown as income on the 2012 return. So I have a quick table here to show the movement of these particular gains and losses over time. 2010, we started the year with a loss of $6,000. We have no carryover from the earlier year, which would have been 2009. We had a $3,000 loss that was allowed in 10, leaving $3,000 of short-term carrying forward to 11. Then in 10, we also had long-term gain or loss of $8,000. No carryover into 10 from 9, and no loss was allowed long-term in 2010. So all $8,000 is carrying forward. Then in 2011, we have a $2,000 short-term gain. We're going to offset that with a $3,000 short-term loss. That means we're going to be allowed $1,000 of short-term loss in 2011 with zero carry forward. On the long-term side, we have 2011 long-term gains of $3,000 being offset by the carry forward of minus $8,000. And that means in the current year, we're allowed maximum losses of $3,000. We're already using $1,000 for short term, so that means $2,000 will be allowed as an offset to income in 2011 for long-term gains, and that leaves $3,000 carrying forward. So 8 minus 3 minus 2 is 3, and that will carry forward into 12. We get into 12, we have a $4,000 short-term gain, no carry forward, all $4,000 is taxable in 12. On the long term, we have a $10,000 gain in 10. We subtract the $3,000 carry forward amount, and we're left with a net gain in 10 long term of $7,000. So how do you figure those carryover amounts? Well, you use the capital loss carryover worksheet that I showed you in the illustrations just above, but also if you go to the Schedule D instructions, on page 7 of the Schedule D instructions, it has the worksheet and line-by-line instructions on how to figure it out. Now, what happens when a taxpayer dies? Death of taxpayer. Capital losses cannot be carried forward after a taxpayer's death. They can only be deducted on the final return. The yearly limit still applies, and any excess may not be deducted by the decedent's estate. Treatment of capital gains. The 28%, 33%, and 35% income tax rates for individuals do not apply to a net capital gain. In most cases, the 10%, 15%, and 25% rates do not apply either. Instead, your net capital gain is taxed at lower capital gain rates. Net capital gain is the gain for the year that is more than the net short-term capital loss for the year. Net capital gains are subject to lower capital gain rates of tax. So the reason people want capital gain income or want to disguise other types of income as capital gain income is because of the lower rates. And so it would stand to reason that when we're working on a tax return and trying to determine the amount of gain that a person has, it's really important to be able to identify actually how much capital gain they really have and make sure that we're not somehow mistakenly reporting ordinary income as capital gain income, because when we do that, we're not assessing the correct amount of tax. On the other hand, if we inadvertently say report harvested timber as farm income when it is in fact capital gain income, we could be doing our clients a big disservice. So let's take a look at the capital gain rates that are in effect in 2012. There is going to be an increase in the capital gain rates for 2013 for certain high income filers, but as we sit right now, 2012 tax law, these are the rates. Firstly, if you sell a collectible, the capital gain rate, the maximum capital gain rate that you can be assessed on the sale of that collectible is 28%. Also, if you sell qualified small business stock equal to the Section 1202 exclusion, then the amount that is taxable is subject to a 28% rate of tax. And I wanted to point out the little asterisks here and then pull you down to this little comment at the bottom. In all the years I've been working on tax returns, I have not run across too much qualified small business stock. It's out there, but there's not a lot of it. Now, there could be a little bit more going on because with the Taxpayer Relief Act of 2012 and some of the other stimulus packages that have gone on in the last few years, there has been a push to encourage more startups for small business, people who have the money to get small startups going. And there are some incentives that the government offers to help stimulate those investments in small business. And they started back in 1993 under Clinton in those days. To help stimulate investment in small business, a 1993 tax law introduced Section Code 1202, which says that you may exclude from taxable income up to 50% of the gain you realize on the sale of qualified small business stock acquired after August 10, 1993. The non-excluded portion of the gain on the sale is subject to tax at a rate of 28%, resulting in an effective overall rate of 14%, because 50% of 28% is 14%, right? The exclusion amount, however, can be up to 75% of the gain for stock acquired after February 17, 2009, and it's even up to 100% for stock acquired after September 27, 2010, and before January 1, 2012. And I believe that's now been extended all the way through 2013. The exclusion can be up to 60% for certain empowerment zone business stock, and the Taxpayer Relief Act of 2012 did extend that 100% exclusion of the gain for the sale of qualifying small business stock that is acquired before January 1, 2014, and is held for more than 5 years. The bill also clarifies that in the case of stock acquired after February 17, 2009 and before January 1, 2014, that the date of acquisition for purposes of determining the percentage exclusion is the date the holding period of the stock begins. Now, I wanted to describe a little bit of an example about what it takes to be qualified small business stock. There's more of it coming up as we talk about Section 1244 losses when we get into 4797. But right now, if you are wondering whether or not you might have a client that has qualified small business stock, it's no small deal to make that happen. Firstly, it has to be a C corporation, and you have to have been one of those initial investors who provided the initial capital to start up that C corporation. I believe there's limits on the amount of initial funding for the corporation. Somewhere around the $1 million mark, I believe, is the limit. There's all kinds of legal documents that need to be prepared by attorneys to make sure everything is in place. But if you have got a client that did make an investment into a startup organization that has qualified small business stock, then if they meet the holding periods, then they would be able to sell that stock in the future and report only half the gain or possibly even none of the gain as income on their tax returns. So it can be a good deal and a good incentive to invest in what would be otherwise a very risky startup venture. Moving on, unrecaptured Section 1250 gain, the maximum rate of tax on that is 25%. So what is Section 1250 gain? Does anyone know? You could send me a chat real quick here if you know what Section 1250 gain is. It comes up all the time. Rental real estate, gains on land, depreciation on a rental, gain on the sale of real property. Section 1250 gain, if you just have the word Section 1250 gain, you could say it would be gain on the sale of land, but it's actually more complicated than that. We're calling it unrecaptured Section 1250 gain. And unrecaptured is essentially a way of saying we've got depreciation that's been claimed in the past, and now we're going to have to include that depreciation back into income because we sold that land or that building at a profit. Typically, you can't depreciate land, so you would never be recapturing or recovering depreciation on land, but you could be recovering depreciation on Section 1250 property, which would be a building on the land. And to the extent that you have a profit from the sale of that building that is attributable to a recovery of depreciation, the capital gain rate that can apply, or the maximum capital gain rate that can apply to that recovery of depreciation, is 25%. So when you're looking at this table that comes out of IRS Pub 17 and you see 25% for unrecaptured Section 1250 gain, it's a very specific thing. It's saying there was a business asset, it involved real estate, depreciation was claimed, it was then sold at a profit, and to the extent that any part of that profit is attributable to recovered depreciation, then that depreciation is going to be subject to a maximum tax rate of 25% rather than the next category underneath, which is a maximum tax rate of 15%. So we've just discussed 3 different capital gain rates that are higher than the normal capital gain rate we normally think of, which is 15%, and the next one on the list. And the 15% rate applies to other gains, and your regular tax rate that would apply is 25% or higher. What that means is if you are in the 25% or higher bracket, then the maximum rate at which your capital gains can be taxed is 15% for 2012. For 2013, it will go up to 20% if your income is high enough. Now, if you are in a tax bracket lower than the 25% bracket, in other words, you are in the 0, 10%, or 15% brackets, and you sell assets at a capital gain, then the tax rate that applies is 0%. Qualified dividends. If you received qualified dividends, your dividends qualify to be taxed at the 0% and 15% tax rates instead of ordinary income rates. Beginning again in 2013, a 20% rate will apply to taxpayers who have incomes above a certain threshold amount. Just going off the top of my head, I didn't look it up before today's class, but I believe it's $250,000 for a single person and $400,000 for a married couple of income before you move into those higher rates. So most people are not going to be affected by them, but wealthier people, people with higher income, clearly will be hit. Qualified dividends and holding period. To qualify, a dividend must be received on stock held for more than 60 days in the 121-day period beginning 60 days before the ex-dividend date. So what this is saying is qualified dividends get lower tax rates. How do you know if you have a qualified dividend? Well, to hold a qualified dividend, you have to have held the stock in the corporation for a minimum of 60 days prior or after the date that the dividend was issued. So if you purchase stock in Dell, and 2 days later Dell issues dividends, those dividends would be ordinary dividends to you. They would not be qualified dividends because the dividends were distributed or issued immediately after you bought the stock. But if you held the stock for 3 months and then Dell issued dividends, that would be a qualified dividend because it falls 60 days later. There's an exception to this holding period. If you hold preferred stock, you must have held the preferred stock for more than 90 days in the 181-day beginning 90 days before the ex-dividend date. And how do you report qualified dividends, or how do you figure the qualified dividend tax rate? Well, firstly, you begin by completing Form 1040, and on line 9A and 9B, you enter the amount of dividends and qualified dividends that you received. And then you use Schedule D, or the Qualified Dividends and Capital Gain Worksheet, whichever applies, to figure the amount of tax you owe on those qualified dividends. Qualified dividends are not included in investment income. If you paid margin interest or you had investment interest expense during the year, your investment interest deduction is limited to your net investment income. In general, qualified dividends are excluded from investment income. However, you may elect to treat qualified dividends as investment income on Form 4952, line 4G. This is a very specific topic. We covered it in our course called Itemized Deductions Part 1, and in Part 1 we look at deductible interest, including deductible investment interest, and in that course we looked at how to complete Form 4952. We'll not be doing it today, but if you want to know where to go, you could read the instructions for Form 4952, or you could take our course Itemized Deductions Part 1. And next up we have an illustration to show how all of this works, and at the end of this illustration I think we'll be due for a break. Illustration, figuring the lower capital gain rate for qualified dividend income. James had $43,000 of wage income for the year. He also received a 1099 DIV that reported $5,000 of dividend income in Box 1A and $4,500 of qualified dividend income in Box 1B. I'm just asking you to imagine that you're holding a 1099 dividend and that you're looking at the income reported on it. And Box 1A says $5,000 and Box 1B says $4,500. So that tells you his gross dividends are $5,000, his qualified dividends are $4,500, and we move over to the 1040 return, and on line 9A, we're going to enter $5,000 of ordinary dividends, and on line 9B, we're going to enter $4,500. $4,500 of the $5,000 are qualified dividends, and that tells me we now need to complete a worksheet to determine the amount of tax. Now for this particular filer in this illustration, whose name is James, he has a W-2 reporting $43,000 of wage income. He has $5,000 of dividends, of which $4,500 are qualified, and his adjusted gross income for the year is $48,000. His total income and AGI are the same amount. We move over to page 2 is Form 1040, and he claims a standard deduction, and he also has to figure his tax. And then he gets to line 27 where he has his taxable income where he needs to figure his tax. So $5,950 plus a personal exemption of $3,800 leaves him with taxable income of $38,250. Well, normally when you get to line 27 of the 1040A or line 43 of the long form 1040, you would go to the tax tables or the tax rate schedules to figure your tax. But anytime you're dealing with capital gain income or qualified dividend income, you can't just do that. You're going to have to fill out a worksheet to figure out how much tax this character James is really going to need to pay. So let's go do that together. We start the qualified dividend worksheet by looking at his income on line 27. What is his taxable income? That's the first line that we're going to look at on the worksheet, $38,250. Then on line 2 it says how much qualified dividend income did he receive, and we enter that amount. There's also space on the form that provides an option for us to show how much qualified dividend income we elected to treat as investment income for purposes of claiming a deduction on Form 4952. We didn't do that, and so line 5 is 0. So the total amount of qualified dividend income that we are going to take capital gain treatment for is the $4,500. And we're going to subtract that $4,500 of qualified dividend income from the adjusted gross income, or from the taxable income, rather, of James. When we do that, we get $33,750. The next step is to say, okay, well, where does that $33,750 put us in terms of tax brackets? So we go over to this chart here. On line 8 it says enter $35,350 if you are single, $70,700 if you are married filing joint, or $47,350 if you are head of household. Well, he's single, so we're going to enter $35,350. That's more than the amount of line 7. That's interesting. The reason it's interesting is because to the extent that his income is below $35,350, he is in the 15% or lower brackets. And what happens when you're in the 15% or lower brackets when it comes to capital gain income, folks? Who remembers? You can send me a chat. That's right. There's a 0% tax rate that applies. But he's not going to be able to claim 0% on all of his qualified dividends because you can see that his income is at $33,750, and the threshold amount where he moves into that higher bracket is $35,350. So we're obviously going to have to do a computation here to see how much of his qualified dividend income is going to get that 0% treatment. And the math shows us that the result is $1,600. So $1,600 of his qualified dividend income is going to get taxed at 0%. So clearly we're going to have to take $1,600 from $4,500, and when we do that, we get $2,900. And $2,900 of his qualified dividend income is going to be taxed at what rate? 15%. So now it's time to calculate the tax on the remaining qualified dividend. You can see line 15 says multiply line 14 by 15%. $2,900 times 15% is $435. But wait, we're not done. Now we still have to do some figuring. Line 16 says figure the tax on the amount on line 7. That's this number right here, $33,750. Well, how are we going to figure the tax on that? That is James's non-capital gain income. That's his ordinary income. And the place that we figure tax on his ordinary income is from the tax tables. So if you were holding Pub 17, you'd open it up and you'd flip to the tax tables in the back and you would find his filing status, you would find his income, and you would figure his tax. And if you did that, then the tax that you would come up with is $46,031. The next step is to take the $435 of capital gain tax, add that to his ordinary income tax, and when you do that, you get $5,066. But you're still not done. IRS says now what you need to do is return to line 1 and go to the tax tables in Pub 17 and look up the tax on $38,250. When you do that, you get $5,599. And the final step is to take the lesser of line 18 or line 17, and clearly line 17 gave us the lesser number, and it should give us the lesser number because of the lower tax rates that he was exposed to. And therefore, 5,066 is going to be the number that carries all the way back up and is entered on line 28. Everglades, Everglades. Everglades. We're moving on to the next category of the day, which is reporting gains and losses. And how you report a gain or a loss depends on the nature of the property you sold and the manner in which you sold it. Firstly, we're going to look at personal use property. You report the sale of personal use property on Form 1040, Schedule D, and on Form 8949. You do not normally need to report the sale of personal property that you sold at a loss because the loss is not deductible. However, if you receive Form 1099-S, which is usually given in relation to the sale of land, your home, or a condominium unit, you will need to report the sale on Schedule D, and your allowable loss will be 0. In this situation, Schedule D and Form 8949 would be filed for the purpose of showing IRS that the sale did not result in a taxable gain. If you sold your personal property for a profit, then the gain may be taxable, and it should be reported on Schedule D and Form 8949. So I'm about to show you an illustration where we have a taxable gain, and we're also excluding a portion of that taxable gain because of the exclusion that's allowed for qualified homeowners who have owned and occupied their home for a minimum of 2 out of the last 5 years. But it's possible that even though you're able to exclude the gain and should not have received a 1099-S, you did so anyway. And so you don't have a taxable gain of any kind because your exclusion is more than the gain, but you still get the 1099-S. And why and when would that happen? Well, where I observe it happening is actually all the time because the exclusion is $250,000 for a single person. And if you sell your house for $300,000 and you're single, odds are you're going to get a 1099-S because the 1099-S is showing that the sales proceeds were greater than the exclusion amount of $250,000. Now, it could be that your profit on the sale is only $50,000 or even that your profit is 0, but there's no way for the company who is managing that sale, the title company that manages the sale and issues the 1099-S, to know what your profit is. All they know is that the gross sales proceeds are more than $250,000, so they issue the 1099-S. And with married couples, that amount is $500,000. In certain parts of the country, including Portland, it's not that hard to find a house costing over $500,000. They're pretty common in California, New York. I'm sure every other house is worth a lot. And so 1099-S's I do see flying into my office all the time, even though people don't have to pay tax on the gain. And when that happens, then the sale is reported on 8949. We claim the exclusion and no tax is owed. The illustration I'm about to show you, though, does have a small amount of tax or a certain portion of the gain from the sale still being taxed because the exclusion is less than the gain. So generally, if you owned and occupied your main home for 2 of the previous 5 years and your gain is $250,000 or less, or $500,000 if you were married filing a joint return, then you do not need to report the sale of your home on your tax return. However, if you received a Form 1099-S, then you should still report the sale on Schedule D and Form 8949, and you would follow these procedures. Complete the Schedule D for the sale of home worksheets to determine your cost basis and the amount of gain that you had from the sale. Then report the gross proceeds in Box 2 of Form 1099-S in Part 2 of Form 8949 with Box C checked. And then in Column A of Form 8949, you would provide a description that would be main home. You would enter reason code H as the reason why the gain is not taxable and the amount that you're excluding from taxation. And then in the remaining columns, you would enter the sales and cost basis information for the home. We would then show you how all of this looks on an actual return. Now, those of you who have not already learned about our free sample course inside Pacific Northwest Tax School's website, there is an option there where you can take a free sample course. And it happens to be the free sample course that we're giving away, 1 hour free CPE, is all on sale of the home. And so it provides much, much more detail about sale of home than I'm covering today in this class on sale of assets. In other words, we have a dedicated course just for that topic. But here in today's class, I'm going to touch on one key illustration and also a description of the 1099-S, essentially how to read it. This is a 1099-S, and typically when I have a client who has received a 1099-S, it looks exactly like this. That's not always the case with IRS documents. Most companies, brokerage firms, for example, will often issue substitute 1099 documents that look nothing like the IRS standardized form. But when it comes to 1099-Ss, when my clients bring them in, they pretty much look exactly like what you see on the screen in front of you. And on box 1, we would report the date of close. Box 2 is the gross proceeds from the sale. 3 is the address of the property sold. Box 4 is that the transfer received or received property or services. That's not normally checked. But box 5 is the buyer's part of real estate tax. And if there's a number there, you need to do something with it. If you are the buyer of the property and you brought taxes to the table when you closed, and those went through as payment to the seller of the property because the seller had prepaid taxes attributable to a period of time after they sell, then when you purchase that property, you're going to have to reimburse them for their taxes. Typically, if you're coming to the table and you're making that kind of a transaction to pay into taxes that you now owe because of a period of ownership for the property you're acquiring, those may show up on the 1099-S. So if you're the buyer's part of the real estate tax shown in box 5 would be deductible to you. But if you're the seller, then the buyer's part of the real estate tax might be either a reduction in the amount of deduction you're allowed to claim for taxes paid, or it could possibly be even income to you. And whether it is one or the other is covered in our course Itemized Deductions Part 1, where we talk about tax deductions on Schedule A, but also taxability of certain refunds. Here is an illustration of reporting sale of home and then claiming the exclusion on the gain. Peter and Betty Pan sold their house for $742,000. They had no selling expenses. Their gain on the sale is $660,000. The Pans are married and filing a joint return and meet the ownership and use tests. They qualify to exclude $500,000 of gain. The remaining gain of $160,000, which is $660 minus $500, is reported on Schedule D. Form 8949 and Schedule D are completed for the Pans as follows. So we start off on Form 8949. The sale of a home, clearly if it's held long enough to claim the exclusion, it was a long-term sale. And so we're going to fill out Form 8949, Part 2 for long-term transactions. We're then going to check Box C because it's not reported on a 1099-B. It was reported on a 1099-S. And then we go in and describe the sale. Main home in column A, the date acquired, the date disposed, the sales proceeds, cost or other basis, and then we have a code here. The code represents the reason why we're making an adjustment to the gain. And in this case, code H for sale of home, and the amount of the adjustment is $500,000, so the gain that we're reporting is $160,000. We then move over to Schedule D for the Pans. On line 10, for long-term sales on Form 8949 with box C checked, we enter the proceeds, the cost, the adjustments, and the gain. And of course, this $160,000 gain will carry to line 13 of their Form 1040, and it will be taxed at a maximum rate of 15%. Sale of stock. Now, when I'm working on taxes, as a general rule of thumb, sale of stock is probably the most common sale item I deal with, and we deal with hundreds of them every tax season. Lots of our clients have stock portfolios and are dealing and trading in these a lot. So it's one of the things I work with frequently. If you sold stocks, bonds, or commodities, you should receive a Form 1099-B called Proceeds from Broker and Barter Exchange Transactions, and you are required to report all taxable sales of stocks, bonds, and commodities on Schedule D and Form 8949. I've noticed that there's quite a number of taxpayers and tax preparers out there who feel a little bit lazy and want to take a shortcut, and the shortcut is to just look at the net income for the year, the net of all sales, the net of all costs, and carry that over as long-term, short-term. But IRS says that's incorrect. They want to see each and every trade listed, and that can be a lot of work, especially if you're dealing with a client who has a portfolio that's thousands of sales in any particular year. But we'll talk a little bit about some options that are available for those types of situations in a little bit. Sale of stock is subject to some additional rules that do not apply to the sale of other property, and one of the more important rules concerns wash sales. A wash sale occurs when you sell stock at a loss and then repurchase the same stock within 30 days prior to or after the sale. Under the rules for wash sales, you may not claim loss on your sale. The loss on the sale of your old shares adds to your basis in the new shares. And here is an illustration where the wash sale loss adds to the basis of shares that have been repurchased. Your basis in XYZ stock is $1,000, and you sell XYZ stock for $750. Then within the 30-day limit of that sale, you buy the same stock back again for $800. And how often do I see my clients doing that? A lot. There's two different kinds of stock purchasers that I observe. There are the people who are pretty good at what they do. They make very thoughtful, informed decisions about what they're buying, and they purchase stock and typically sit on it, or if they sell it, they've really got some methodologies that they know what they're doing. And typically, they also have portfolios that are managed by professionals who make their living knowing where to buy and sell. But the other side of the equation are people that I almost think are a little bit like gamblers. Instead of going to Vegas and playing the slots, they like to sit on their home computer and buy and sell stock. And it's those kinds of investors that typically are losing their money. They see stock is rising, so they buy it. Then they see it's falling, so they sell it. Everything is kind of a knee-jerk panic reaction. And those types of buys and sells, you have to be really on top of whether or not there's a wash sale. And in our illustration here, we buy for $1,000, sell for $750, and then within 30 days buy again at $800 because we see that the value is rising again. So that's a wash sale, and we're going to have to make an adjustment to basis to deal with that. Then in the same year, your basis in ABC stock is $2,000. You sell ABC stock for $900, and within 30 days you purchase ABC stock again for $800. Because you bought substantially identical stock, you cannot deduct your XYZ loss of $250 or your ABC loss of $1,100. You must add the disallowed loss to the cost of the new stock that you obtain, and that will become the basis in the new stock. Your basis in the new stock is your disallowed loss added to the cost of the new stock. So here we have XYZ stock. You buy for $1,000, sell for $750, resulting in a $250,000 loss that you're not allowed to claim. You then buy for $800, so your basis in the new shares is going to be $800 plus the disallowed loss of $250, giving you a basis of $1,050. For the ABC, you bought $2,000, sold at $900. The disallowed loss is $1,100, and it will add to the basis of the new stock purchased for $800, so the cost basis of the new stock will be $1,900. Now, beginning with tax year 2011, Form 1099-B provides a space for reporting disallowed losses on wash sales in Box 5. That's a nice feature. It's definitely cut down on the amount of work I have to do, because if I'm dealing with a 1099-B that shows the wash sales, Form 8949 actually counts for those. So if you've got tax software that is communicating correctly with 1099-B, and you have entries on 1099-B showing that there was a wash sale for a particular stock, and you tell your software that there was a wash sale and the amount of the wash sale, then the software will actually disallow that wash sale and subtract it out again in as an adjustment item. So it's quite a nice feature that is very labor saving, but it will of course only work if you're actually using the software and correcting your stock entries properly. 1099-B, proceeds from broker and barter exchange transactions. We're going to now talk about this document and the changes that were made to it and why. Firstly, the IRS, or the government, our government, probably the General Accounting Office, did a study. And it showed that 7 million taxpayers, which was more than 1/3 of those who sold securities in a particular year, may have misreported their gains and losses. And about half of them did so because they misreported their basis. A new law aimed at reducing basis reporting errors by taxpayers began phasing in for tax year 2011, and the law requires basis reporting on Form 1099-B proceeds from broker and barter exchanges for those publicly traded securities. The new reporting requirement applies to stock purchased after 2010. Form 1099-B was revised for 2011 and again for 2012, adding new boxes to report the following information that was not reportable in earlier years. We begin with the date of acquisition. Of course, that actually was not always there. It is now. This box, however, may be blank if box 6A is checked or if the securities sold were acquired at a variety of dates. For short-term sales, the date shown is the date you acquired the security delivered through the close date. Then we have box 1C, which is new for 2012, and it reflects the type of gain or loss, either short-term or long-term. And then we have a new box 1D for 2012, which includes the stock or other symbol of the security being sold. Box 1E, which is the quantity of shares sold. That was an omission, I thought. In 2011, there was nothing to indicate the number of shares sold, and that's really important. If you have a client who has information showing they purchased 1,000 shares, and then they get a 1099-B that shows they sold $10,000 worth of shares, but not the number of shares sold, then there's no way to know how to figure their basis. You really need to know how many shares were sold so you can work backward to the number of shares originally purchased, and we'll see how that works in an upcoming illustration. Box 3, cost or other basis of securities sold. If Box 6A is checked, Box 3 may be blank. See Schedule D, Form 1040 instructions, or Publication 550 for details on how to figure basis in your cost. Box 5, wash sale disallowed. The amount of non-deductible loss resulting from a wash sale is shown here. For details on wash sales, see the Schedule D instructions or Publication 550. And then we have Box 6A, which is a non-covered security. This box is checked if the stock was acquired prior to 2011. If Box 6A is checked, then Boxes 1B, 1C, 3, and 5 may be blank. So all of these boxes up here may be blank if Box 6A is checked. But if the next box, 6B, is checked, then all of these boxes should have numbers in them. And Box C is where basis is being reported by the securities company to the IRS. The whole point of all of this is that if you file a tax return and you fail to report the correct amount of basis and the correct amount of gain on the sale of a stock, then the IRS can use this information to figure out what your gain should have been. So if I'm looking at all of the reasons why clients come to us because they've received a letter from the IRS, there's a couple of main reasons people receive letters from the IRS. One is that they have failed to report a W-2 or some other income that they had during the year. They just left it off. And IRS has noticed that there's a difference between, say, the W-2 income reported on the tax return and the amount of income that was reported to the IRS through employers. That's called a CP2000 letter, and it's issued when there's a difference. But another reason why CP2000 letters are issued, a very common reason, is over these brokerage accounts, particularly when we're dealing with employee stock purchase plans and employee stock options. Very often, those particular transactions where stock are sold and income is provided to the employee through their W-2, those are handled on the stock markets, but the employee is never a part of the transaction and may not even be aware that a transaction occurred on the stock market. And subsequent to that, a 1099-B is issued, but very often the employee doesn't receive it in the mail. It's there in their online account for them to go download and print, and since they didn't know there was one there, they don't print it, and then they don't report it on their tax return. Another thing that I see in the line of reasoning of tax clients is that they're perfectly aware of the fact that the income from the sale of a stock option through their work was included in their income. And since it was included in their income, then why should they have to report it on their tax return and pay tax on it again? So they deliberately leave it off. Those are the two key reasons that I see clients come in with these CP2000 letters. And the IRS is, of course, acknowledging that it is a huge problem. And so these efforts and these changes made to 1099 DIV and to Schedule D and Form 8949 are all in an effort to narrow down the errors in reporting and improve accuracy for tax filers. So with that, in order, of course, for a 1099-B to contain basis information, there are some rules in play about when that has to occur. If Box 6B is checked on the 1099-B, then the security sold is considered to be covered. That means it's covered under reporting laws. It's required to report it. It's covered in terms of the law. An uncovered security is one that is not covered, or a non-covered security is one that is not covered by the law, is not required to be reported to the IRS in terms of basis. Proceeds from the sale are still reported, but the basis is not. So covered versus non-covered, the term covered securities describes investments for which financial institutions are required to report realized gains and losses to the IRS. These include individual stocks that were purchased after January 1, 2011, mutual fund shares purchased after January 1, 2012, and bonds, options, and other securities purchased after January 1, 2013. So you can see here that with 2012, we were only halfway through that phase-in period. Right now, currently, as I'm teaching this class, we're in 2013. And when we move into 2013, that's going to be the final phase where we now see that all forms of securities need to have basis reporting on the 1099-B. However, if you're dealing with stock purchased before 2011, basis is not required to be reported to the IRS. If you're dealing with mutual fund shares purchased before 2012, basis still does not need to be reported. And if you are dealing with bonds, options, and other securities purchased before 2013, those too do not need to have their basis reported. So it's going to be quite a few years where we're dealing with situations where some securities have basis reporting and others do not. Over time, obviously the thinking is that we'll eventually get to a point where basis is always reported on these items. Now, a non-covered security is one that was acquired before the dates I just mentioned, and individuals, investors in those situations are solely responsible for reporting gains and losses on non-covered securities to the IRS. Here we have the 1099-B in front of us, and you can see on line 1A we have the date of the sale or exchange. On line 1B, the date of the acquisition. Then we have box 1C, where we are either checking short-term or long-term. We have space for the stock or other symbol number, and 1E is the quantity sold. On line 2A, we enter the proceeds from the sale of stocks. And then there's a box which says, was the gross proceeds reported to the IRS, or was it something slightly less than the gross proceeds because the brokerage commission was subtracted out? And then we have box 2B, check if loss is not allowed, based on amount in box 2A. On line 3, this is where the cost or other basis is entered, but box 3 will only have a number in it, typically, if box 6B is checked. If box 6A is checked, then box 3 would be blank. And then we have line 5 for wash, sale, loss, disallowed. 7 is for bartering. 8 is the description. And then there's a few other boxes in here as well that I'm not going to get into today. But the main deal with a 1099-B is that, remember earlier where I said a 1099-S looks pretty much like a 1099-S when your client brings it in? Well, when your client brings in a 1099-B, it will probably never look like this. Instead, brokerage houses typically issue something called a substitute 1099-B, where they simply list on a single line the box numbers and the numbers that would be inside of those boxes without actually displaying them on a form. And I'll show you what those look like in a couple of minutes as illustrations come up. We're now going to talk about Form 8949, Sale and Other Dispositions of Assets. Sales of property can no longer be reported directly on Schedule D, and instead sales are reported on Form 8949, Sales and Other Dispositions of Capital Assets. This change accommodates changes to reporting information shown on Form 1099-B. Use Form 8949 to report all sales and exchanges of capital assets, including stocks, bonds, etc., and real estate, except where these sales are reported on Form 4684, 4797, 6252, 6781, or 8824. If you are dealing with a situation where the sale was reported on any of these other forms, then you do not also report the sale on Form 8949. You should include transactions on Form 8949 even if you did not receive a 1099-B or a 1099-S or substitute statement for that transaction. You're going to report short-term gain or losses on line 1, and you're going to report long-term gains or losses on line 3. You enter the details for each transaction on a separate line of Form 8949, and you should use as many Forms 8949 as you need. And to show you how many that could be, you'll see how long our illustration is. We've got a client this year and last year. I think their tax return is over 100 pages long by the time we're done with all of the 8949s and the sheets that follow it. So these can create very labor-intensive tax returns, expensive tax returns to complete when you're dealing with a large portfolio. There is an exception to this rule where you have to list every single transaction, and you should pay attention to this because if you want out of a lot of work and your client is agreeable to this and they have all of the necessary documents in the correct format, you can do this instead of individually entering each transaction into your computer. So instead of reporting each of your transactions on a separate line of Form 8949, you can report them on an attached statement containing all of the same information as 8949 and in a similar format. So in other words, if you look here at the 8949, it's got the description, the date acquired, the date sold, the proceeds, the cost or other basis, code relating to any adjustments, the amount of the adjustment, and then the net gain or loss. If you have a statement that is in this same format, The IRS says you can attach that statement instead of completing Form 8949, and that you can use and attach as many statements as you need. You then enter the combined totals from all of your attached statements onto a Form 8949 with the appropriate box checked. You can see here we're looking at 8949 Part 1, and the box has Box A, Box B, or Box C that would be checked. So if you've got a particular brokerage statement and all of the transactions for the year are on that brokerage statement in precisely the format that they need to be in, and they're divided according to the boxes that you see here, then you could attach the statement to the return, check the appropriate box, and then in the description you would describe the name of the statement or the firm. Now what you should not do, or the next step after you do that, is if you have statements for more than one broker, report the totals for each broker on a separate line. And if you e-file instead of filing paper, which of course as professional tax preparers we're required to e-file these days, you would attach the statements to Form 8453 and then mail them to the IRS. So in other words, when you're filing electronically, you have your client sign 8879 is the form that your client signs, authorizing you to electronically file the return. And in the electronic file of that return, you could have a summary of those sales on the 8949, and you could click send and send it off. But IRS still wants those individual transactions, and so you would paper file with the IRS a form called 8453, and you would staple to that 8453 the statements that are described here, and then mail them to the IRS. What the IRS does not want you to do in the space provided on the lines is write something to the effect of available upon request or enter summary totals in lieu of reporting the details of each and every transaction. So let's take a look at 8949 right here. We have Part 1, short-term transactions. And then underneath Part 1, we have a series of boxes to check A, B, C, or D. And if you read the lines, it says Box A, short-term transactions that are reported on a Form 1099-B and basis was reported to the IRS. We then have short-term transactions reported on Form 1099-B, but basis was not reported to the IRS. And finally, we have short-term transactions which were not reported on a 1099-B at all. You would check the box that's appropriate, and then in the lines below, describe each and every sale that is short-term, if you checked box A, with basis reported. If you have a brokerage statement that has some short-term sales where basis was reported and other sales where basis was not reported, then you would need two Form 8949s. And on one of the 8949s, you would check box A and list all of the sales where basis was reported. And on the next 8949, you would check box B and list all of the sales where basis was not reported. Well, this is a logarithmic thing, folks. When I'm dealing with these types of transactions and we're in a situation where we're manually entering those, if you've got 5 to 20 transactions, getting them all correct and getting them balanced on the 8949s and carrying to the Schedule D correctly is a little bit of work, but not too bad. But if you take that number and you double it to 40, and you take that number and double it to 80, and then you get to a point where you're dealing with 1,000 transactions, and you make an error, finding that error and balancing can be horrendously difficult. Some software packages do have an ability to import this information if it's all formatted correctly, but that still means that you have to get the file delivered to you by your client or from the brokerage house in a compatible format that you can then sort for importation. We use Drake software, and it will import Excel spreadsheets. So if you are able and you use Drake to get information from your client in an Excel or a spreadsheet type format, then Drake has some instructions on what you need to do to that Excel spreadsheet to make it compatible with Drake, and then you just click import and the whole thing just sucks in. Doesn't mean it sucked correctly. If it got into your software and it wasn't perfect, or if your fields were off in any way, then the entire import will be bad and you'll need to delete it and start over again. But when it is working correctly, it does save a lot of work, and with our larger files, that's what we do. Possibly you've got another software that does a better job even than Drake, but the point being, when you're dealing with very large files, it can be worth taking the time to put your efforts into creating formats that are compatible with your software and putting your time into that so that the importation is successful, rather than hand entering each of those line items one at a time. Whichever works better for you. In the end, you'd better balance, because if you don't balance, the IRS will figure that out and your client will get a letter. And that's one of the things that I've noticed in the last year, is I'm now getting clients who are coming to me with letters from the IRS saying that we have transactions that were reported to us as sales, individual stock transactions that were reported to us as sales, and you did not report that specific sale on your tax return. In other words, you reported 50 sales, but you didn't report that sale. And I'm looking at the letter that my client is getting and saying, no, that sale was reported, and here's the line, here's the description. So why did IRS decide it wasn't there? It's probably that their systems are still not quite working correctly, and they're going to be, for a period of time, kicking out letters that say there are mismatches when, in fact, there are not mismatches. And so you should let your client know that if they get a letter saying that there's a mismatch between the return with relation to those brokerage reports and what was reported, that they should bring the letter to you so that you can verify whether or not that's a particular transaction that you did report. And I see some questions coming up. I believe the IRS does not want all that info and now says they will request it if needed. Do you agree? I think that what I am seeing in the instructions from IRS is that they want each individual brokerage account sale reported. You can bunch them in certain situations, like if you have 3 buys that are all sold on the same date and they are the same stock, that you can lump those together. But if you've got individual trades within a brokerage account, they want them all each and individually identified on the 8949. And what I'm just finished explaining to you, where I have a client where we have gone through and reported individual transactions, 50 or more, he's still getting a letter saying that one was missing. So if you lump them all together, that's probably a sure way of making sure your client gets even more letters. Now, moving on. We've just gone through a description of how to read and interpret 8949's Part 1, and that is for short-term transactions. You enter all of your transactions on the lines allowed for on line 1. Line 1 just goes on and on and on. You can keep attaching summary sheets. We eventually get to a point where you've listed all of your short-term transactions with either box A, box B, or box C checked. And when you've done that, you total them all. And then we move on to the next side, page 2 of 8949. And on page 2 of 8949, you indicate your long-term sales. You have long-term transactions reported on Forms 1099B where basis was reported. If that's the case, you check box A. Box B is for long-term transactions reported to the IRS, but basis was not reported to the IRS. And box C is for long-term transactions that were not reported on a 1099B. Again, they could have been reported on the 1099S or some other form of document, but they were not reported on the 1099B. And if that's the case, you check box C. Now, you should use a separate Form 8949 Part 2 for each of the following transactions. And essentially, whichever transaction you have, box A, B, or C, as soon as you generate a long-term transaction where basis was reported, you're going to need to check that box. And as soon as there's a transaction where basis was not reported, you're going to have to check that box. So theoretically, it's possible to have a tax return where you've got 6 pages of 8949 and you only had 6 sales. Now, normally, you would only get up to 6 pages if you had a lot more than 6 sales, but theoretically, it's possible if you had exactly 1 of each category. So taking a look now at the 8949, it is comprised of several columns. And the first column we look at, column A, is where we enter a description of the property sold. Column B is where we enter the date that the stock was acquired. In column C, we enter the date sold. And if we acquired the stock through inheritance, then we would enter inherit as the date acquired. The date we sold the stock is entered in column C, the sales price in column D. In column E, we enter the cost or other basis. And remember that if we're dealing with cost basis reported on the 8949, we actually enter what is on the 8949 if it is a covered security and the basis is reported. But if it's not a covered security with basis reported on 8949, then we would actually enter the adjusted basis as we calculate it. There's a difference between the actual cost basis and the amount reported on 1099B, and the amount reported on 1099B is a covered security. Then we would need to enter an adjustment in the column. If we do need to make an adjustment, we enter a code for that adjustment to explain why we're making an adjustment. And then in column G, we enter the amount of the adjustment and how much that is. Column G is adjustments to gain or loss. And we're still looking here at the 8949 in the back of your mind, folks. We're looking at all of the columns running across it. And we're now to the point where we've got column G, which is where we enter an adjustment. In this column, you will enter any necessary adjustments to the gain or loss. You will enter negative amounts in parentheses to create a loss or reduce a profit. And you will also enter a code in column B to explain the adjustment. You should include in this column any expenses of sales such as brokerage fees, commissions, state and local income taxes, and option premiums, unless you reported the net sales price in column E rather than the gross sales price. More than one code. If you entered more than one code in column B on the same line, enter the net adjustment in column G. For example, if one adjustment is $5,000 and another is $1,000, then you would enter $4,000, which is $5,000 minus $1,000. And then finally in column H, that's the point where you get to the net gain or loss, and that's a change for 2012. I don't know if you noticed, but in 2011 it didn't show the net gain or loss, and that was a royal headache. If you're trying to balance your client's brokerage account statement against your data entry, and their statement shows net gain or loss on each transaction, but yours doesn't, it created a royal headache for trying to do any balancing in the 2011 tax year. But for 2012, column H now has a space to enter the net gain or loss. And in this column, you will obviously figure what the net gain or loss is and write it down. Now, I've mentioned several times that there's these columns where you enter adjustments, and the adjustment has a code, and these are the codes that you can use. And the most common one that I'm using is code B. If you receive a Form 1099-B or substitute statement and the basis that is showing in box 3 is incorrect, then you would enter a code B, and you would then enter the correction to the basis. So in other words, if the statement says that your basis is $1,000, but you know your basis is really $1,200, then that would be a negative $200 that you would enter in the adjustment column, and you'd indicate that with a code B. And that would cause your basis to be more than what is showing, and the negative 200 would cause you to have a smaller gain. Also, if you received a Form 1099-B and the type of gain is reported incorrectly, in other words, it's showing that the gain is long-term when it's in fact short-term, or it's showing it short-term when it was in fact long-term, you would enter a code T. If you received a Form 1099-B or a 1099-S as a nominee for the actual owner of the property, you would enter a code N. If you sold or exchanged your main home at a gain, and you can see in the earlier illustration we did that we entered a code H because you're claiming the exclusion on the gain. If you sold or exchanged qualified small business stock and you're excluding 50, 60, 75%, or 100% of the gain on the sale of that small business stock, you would enter a code S. And then we move on to the next page, code W. That is entered if you have a non-deductible wash sale. If you have a non-deductible loss other than a wash sale, you would enter a code L. And then finally, you include any expense of the sale or certain option premiums in column G, or you have an adjustment not explained in any of the above columns, you would enter a code O. And then if none of the statements in any of these columns apply, in other words, you just don't qualify, you're going to leave the column blank. And now moving on to Schedule D. So you've gone through and you've taken a look at the 8949, you've put some effort into completing it, and now it's time to complete the Schedule D. Schedule D is significantly changed for 2011 and later years, and many transactions that in previous years would have been reported on Schedule D must now be reported on Form 8949. You need to complete Form 8949 before you complete Schedule D, and you will notice that Schedule D has lines 1, 2, and 3 for reporting the different categories of short-term gains, and it has lines 8, 9, and 10 for the different categories of long-term gains. You're going to use Form 8949 to report the sale or exchange of a capital asset not reported on another form or schedule, such as 4797 that we're going to talk about later, and gains from involuntary conversions other than from casualty or theft of capital assets that are not held for business or profit, and from non-business bad debts. You're going to use Schedule D to figure the overall gain or loss from transactions that were reported on Form 8949, and also to report gains from Forms 2439, 6252, or Part 1 of 4797. You're also going to use Schedule D to report a gain or loss from 4684, 6781, or 8824, and to report a gain or loss from a partnership, S corporation, trust, or estate. Finally, you use Schedule D also to report certain capital gain distributions that you could not report directly on Form 1040. Usually that happens because Schedule D is already required for other reasons, and if it is, then you will enter your capital gain distributions in the space provided on the form. And finally, you use the form Schedule D to report a capital loss carry forward from 2011 into 2012. So you will note here that Part 1 of Schedule D says complete Form 8949 before you complete these lines. If you completed 8949 Part 1 with Box A checked, you would enter the total on line 1. And if Box B was checked, you'd enter that on line 2. Box C, you use line 3. When you're done entering all of those amounts, then you're going to total up your short-term gains or losses for the year and enter those on line 7. And if you have a short-term loss carryover, that, of course, is subtracted out on line 6. For long-term, it's all of the same requirements, except that Box A is entered on line 8, Box B is entered on line 9, and Box C is entered on line 10. Your long-term capital loss carryforwards are entered on line 14. And if you have a capital gain distribution showing on a 1099-D IV, that would be entered on line 13. You'll also notice that Schedule D provides space or a line for entering long-term gains or losses that are flowing through to you from your share or ownership share in an S corporation, estate, trust, or partnership. So if your client receives a K1 and that K1 is indicating that you are recipient of long-term capital gain income, then you would flow that capital gain income onto line 12. And then on line 11, we report gains from Form 4797 Part 1, long-term gain from 2439 and 6252, and long-term gain or loss from 4684, 6781, and 8824 on line 11. So you're not going to need to do an 8949 if you filled out any of these other forms listed here instead. Instead, of course, you would fill out that other form as described, follow the instructions for it, and when you finally figure the number, you carry that over and enter it on line 11. Comprehensive illustration, I promised we would have one coming up. Forms required for this illustration are 1040, a Schedule A, a Schedule B, a Schedule D, an 8938, an 8949, the F-bar report. So there's a lot of work to do here. Our character in this story is named Jake Edwards. He is married to Mary, who is a homemaker. Jake is an engineer at Intel Chip Company, and during the year he sold non-qualified stock options. The sale of the options was reported through UBS Financial Services, and Jake's UBS Form 1099-B, UBS Intel Advice of Exercise, and his W-2 are all attached. Jake inherited stock from his father, who was a resident of the UK. His stock remains invested in Barclays of London. The year-end value of his account was £100,000, and the maximum value of the account during the year was £125,000. And at that time, the exchange rate was 0.6410, which means the maximum account value during the year was $195,008 US. The account issued £6,173 in qualified dividends, and we exchange rate that out to $9,630 US. He did not sell any shares during the year. Jake also maintains a savings account with UK National Bank, and the account generated $500 of interest income during the year. The year-end balance and highest balance of the account was $15,000 for the year. He paid $100 to the U.S. of foreign tax to the UK on the interest income. Now, not included in this illustration, but probably also required for reporting purposes, is a Form 1116 to report the foreign tax credit, but we've left that one out. Mary received a 1099 INT from U.S. Bank reporting $1,500 of Box 1 ordinary interest income for the year. But we're not done. The Edwards sold stock and property during the year in the following transactions. They sold some stock holdings through Smith Barney and Sterling. All of the sales are reported on Form 1099-B as shown later. They also sold Intel stock options that were acquired by Jake through an employee stock option plan. An advice of exercise notice issued by Intel is included along with a substitute 1099-B statement from USB. They also sold some vacant land which was purchased on 1/1 of 98, and the land has an adjusted basis of $20,000 and was sold on 10/3 of 2012 for $100,000. The Edwards have long-term capital loss carry forward from 2011 of $5,000. And by the way, we're not done with these thinking because their stock holdings have some splits back in the past. Kroger split 2-for-1 in 2011, and Nike split 2-for-1 in 2011 as well, so we have to figure all of that in. And I felt you could spend a little bit of time thinking about the transactions and analyzing the transactions that are going on for Jake, getting a little bit familiar with them. And we'll go over the actual finished tax return for him and explain what's going on with it. You can see up here we have an itemized listing of the 2012 account activity for Smith Barney. You will see there are some sales, and then below that we have some purchases. Now among the purchases you will see there was some Canon and Chrysler that were purchased, but those were not sold during the year, and so basically for tax purposes we ignore those. It's quite common for our clients to bring into us a brokerage statement that shows all of their buys and sells for the year, and it's quite logical that they would have some buys that had no corresponding sells, and they would have some sells that correspond to no buys during the year. When you have a sell, typically the brokerage account will tell you when it was originally purchased and what the cost basis is, but when you have a buy and there's no sell, you're just going to see the buy. And if you see a buy with no sell, then there's nothing to report for that year. We also see that there was stock acquired by inheritance, NM stock, and this is the amount of cost basis that Jake has for his cost in NM shares. I said, take a look at this Jake Edwards return and think about it a little, because sorting through stock sales takes quite a bit of thinking. You need to analyze each transaction. You need to look at the number that were sold. You need to look at the broker fee. You need to look at the proceeds that are being reported to them. And this is basically a transcript or a summary that's either kept by Jake Edwards himself or it's being given to him by his brokerage firm. But the information you see on here may or may not actually be a match to what's been reported to the IRS. And if there's a difference between what he has on his records and what's been reported to the IRS, we're going to have to make a note of that on Form 8949 and describe those differences. So if you've had some time to analyze each of those transactions, now let's move over and take a look at some of the tax documents themselves. Now, I did tell you earlier in class today that the brokerage houses don't ever issue 1099-Bs that look like the IRS standardized format. But I thought it would be helpful for you to go through the class with me today looking at the standardized format and getting an affinity in your mind for the box numbers and the information that's reported in each box, so that when you see a substitute statement, you're really understanding what the substitute statement is telling you a little more clearly. This first 1099-B is issued by Smith Barney, and you can see it's got the name of the filer. It's got a date of the sale or exchange. We can see that box 1C and 1B are both blank. Then on line 2A, or box 2A, it says the stocks, bonds, etc. This would be the gross proceeds from the sale. That's the income that needs to be reported on 8949. This is an amount that has been reported to the IRS, and we need to precisely match it when we enter gross proceeds on the 8949. We can see that box 6A is checked, meaning it's a non-covered security, and that's why box 3 and box 1C are blank. We have, however, checked that the sales price is less commissions and option premiums. Now, what have we got to say about this particular transaction? Well, let's go down to the description. It's Kroger stock. And up here I told you that we had a buy of Kroger stock on 11/18 of 10. We have a trade price of $24 a share. 60 shares were acquired. The brokerage fee was $20, and the price paid for all of that was $14.40. Earlier up here, I did tell you that Kroger had a 2-for-1 split on 2/1 of 11. So even though down here it says that he bought a total of 60 shares, he actually owned 120. And when he sold 60. So it means he only sold half of the shares that he purchased, and it means his basis in the shares that he sold is going to be half what you see here, and his basis also includes the broker fee, and he's going to include half that broker fee as a part of his basis. So let's turn all of that into words. 60 Kroger shares were sold. The sale was reported on the Form 1099-B. Box A is checked, and basis is not shown. The Edwards records show that 60 shares were purchased on 11/18 of 10 for $1,460. That's $24 times 60 shares plus that broker fee of $20. There was a 2-for-1 split on 2/1 of 11, which reduced the cost per share to $12 and increased the number of shares owned to 120. Thus, cost basis of 60 shares sold is 12 times 60 plus 10, or $730. So we're going to report the sale on Form 8949, and because no basis is reported, it's going to be reported in Part 2 with box B checked. And the cost basis that we're going to enter is $730, and the proceeds will be $22.60. The next line we're on to, or the next 1099-B we're on to, is for the sale of IBM shares. So let's go back up and take a look at these IBM shares. What happened with those? Well, we have a purchase of IBM on 1/5/11, and we have another purchase of IBM on 12/30/09. And we can see that we have a trade price of $55.50 on one of them and a trade price of $50 on the other. The one that was purchased in 2009, that's going to be a non-covered security. But the one purchased on 1/5/11, that would be a covered security. So we're going to be looking for differences in how those are reported and the boxes that would be checked on the 1099-B as a result. So let's go down and see which one was sold. We can see that when we're looking at this IBM, it's covered. Its long-term box is checked. The date of acquisition is entered. We've got basis being reported to the IRS. And we're seeing here that the gross proceeds reported to the IRS are $25.80 and the cost or other basis is $27.75. In my notes here I say that 50 IBM shares were sold. The sale is reported on Form 1099-B and basis is reported in Box 3 and Box 6B is checked. The Edwards records show that 50 shares were purchased on 1/5/11 for $2,795. That's $55.50 times 50 shares plus the $20 broker fee. We're going to report the sale on Form 8949, Part 1 with Box A checked. Now the basis reported to the IRS, however, does not include that brokerage fee, darn it. We're saying that the basis is $27.95, but only $27.75 is reported. There's a difference. Too little basis has been reported, so that tells us that we're going to have to enter a code and then describe a difference for that basis. Moving on to the next 1099-B, this one is for IBM as well, but of course this was the other purchase and sale of IBM that is non-covered. And so we have Box 6A checked. There is no date of acquisition. There is no cost basis entered. We have a sales proceeds of $2,580. So my notes on this particular transaction say that 50 IBM shares were sold. The sale is reported on a 1099-B, but basis is not shown and Box 6A is checked. The Edwards records show that 50 shares were purchased on 12/30/09 for $2,520. That's 50 shares times $50 plus the $20 brokerage fee. We're going to report this particular sale on Form 8949, Part 2 with Box B checked. So even though both of these transactions are for the same company, they're reported on completely different forms. Moving on to the next stock that was sold, we have Nike. 50 Nike shares were sold. The sale is reported on Form 1099-B, but basis is not shown and Box A is checked. The Edwards records show that 25 shares were purchased on 11/15/10 for $1,770. 70 times 25 shares plus their $20 brokerage fee. No basis is reported, so we're not going to have to make any adjustments, but it is a long-term sale, so we will report it in Part 2 with Box B checked. The next item in line is the NM shares. Well, with the NM shares, basis was reported to the IRS, but the basis is wrong. This is inherited stock. The basis shown on the 1099-B is probably belonging to the person that the shares were inherited from and not by the person who inherited the shares. So it's showing a cost basis of $3,000, but we know that that's wrong. Still, it was reported, and it is long-term, so we're going to enter it in Part 2 of 8949, and Box A is checked, so we're going to check Box A, but we're going to have to enter an adjustment or a difference in the columns. UBS statement is up next, and on the UBS statement we have Box 2A. So this is where I'm saying that the substitute statements that you get from brokerage firms are meant to replicate information reported on the 1099-Bs. So here we have a 1099-B, and we've got Box 1A, Box 1B, Box 1C, Box 2A, Box 3, and so on. And we move over to the 1099-B substitute statement. It's saying Box 2A. It's meant to correspond to the 2A that you see here. So $5,000 up there should correspond to a sales price here, and it does. You can see that if you filled out a 1099-B long form, that all of these numbers would find a home. And so you're just going to interpret the numbers that appear on this form as if you were actually looking at a 1099-B statement. And moving on down, we have Jake exercised and sold a non-qualified stock option in a cashless same-day sale. And that's what's being represented here. We have Intel Chipmaker. We have a W-2 showing $128,621 of income. In our course called Basis of Assets, we went in a great bit of detail into how we determine cost basis for a person like Jake when he exercises stock options. And so I'm not going to do a bunch more explaining about that, except just in brief. I'm going to point out that his W-2 does have a code V on it. This code V shows $3,621 of income was reported on his W-2, and that income is attributable to exercise of non-qualified stock options. When you see a code V here, that's telling you that this individual exercised stock options during the year, and that the number next to the code V is included in box 1. So the number next to code V is a part of his basis in the shares that he sold. So let's go up here and take a look at what happened. He sold stock in Intel Chip Company, and it shows that his sales price in that stock is $13,115, and his cost basis is $13,121. So he has a very small loss here of roughly $6. And moving on, we're going to take a look at another document, which is called an advice of exercise. Now, I live in Portland, Oregon, and we have several large high-tech firms around here, not the least of which is Intel. And several years ago, I took an Intel advice of exercise document and converted it for purposes of our class. It's all anonymous here. It's not really representing anything factual that could ever be traced to a particular client, but I can tell you that it is an actual copy of an actual reporting document that is issued by Intel. So I took it and adapted it. Now, this is not a standardized IRS format. In fact, it's not filed with the IRS. This is totally unique to Intel. And why bother showing it to you? Well, I show it to you because I like the way Intel does it. And the way Intel does it is accounting for all of the payroll laws that apply and all of the reporting requirements that apply to exercise of non-qualified options as well as ESPPs and even RSUs. We'll see some reporting of that later today in our classwork assignment. So when you have a client that has a code V on their W-2, that should immediately get your little alarm bells ringing. Okay, this person sold stock during the year. It doesn't mean, however, that a 1099-B was issued by the brokerage firm. It's possible that the brokerage firm sold the shares, reported the income in Jake's income without ever issuing a 1099-B. And I would say roughly 50% of the time that's the case. And the reason that's the case is when an employer does use code V to report income from non-qualified stock sale in the W-2 of an employee, that firm is not required to have a 1099-B issued. Thing is, many firms still do it anyway, including Intel. So when you see a V in this box, that's telling you there's a 50% chance that your client has a 1099-B, and the likelihood is if they have a 1099-B, they aren't bringing it in and showing it to you. Now, if they are showing you a 1099-B and it matches or correlates to the code V, you can wipe your head and go, okay, I've got everything I need. But if they don't have a 1099-B, you're left in a quandary. And the quandary is that there might be a 1099-B, and you can send your client off on a goose chase to try and find it, all to no avail because there isn't one. But it could be that there is one, and they don't know where to go to find it. So that if you don't report the transaction on the tax return, then they're going to get a CP 2000 letter saying that you left it off. So it's really a no-win scenario. If you tell them that it might be there and they go off and look for it and can't find it, then they're going to come back and they can say that there isn't one, and so you're going to leave it off. And then a year later, they get a CP 2000 letter from IRS saying that they left it off. And then the client comes to you and says, why didn't you leave this on? Or why didn't you include this income? And at that point, you can't even remember that you sent them on the goose chase that they got all annoyed about, and they don't remember it either, so you still look like the bad guy. It's a problem. So how do I get around it? Well, the first thing is that I do keep written records of the interaction that I had with my client, that I observed that there was a code V, that I asked them for a 1099-B, that they told me that there wasn't one. And that I then told them, hey, if you did have a 1099-B and we leave this off, you will get a letter. Then clock forward in time several months or a year later, and they do get the letter. You've got the notes to fall back on and say, hey, we did discuss this, but you couldn't find it, or you told me that there wasn't one. Apparently there was. It's not a huge deal, but what it does mean is we're going to have to amend your return to report that sale and report your basis. That's a lot to have to say about this little code V. But for Jake's purposes, we've made it simple. Jake did get a 1099-B representing that sale, and it's right up here. But oh my gosh, $13,115, that's a lot bigger than that number. Why is that? Well, let's take a look. And the advice of exercise explains it all. And as I said, I like Intel because it does it so well. Firstly, we look to the grant price. The grant price is the price that Jake paid for that stock. He's given the right to purchase that stock at a specified price at a specified time. And if you look here, the grant date is 4/14 of 2002. So way back at that point, he was given a grant price of $19. And he waited until 10/1 of 2012 to exercise the right to purchase that stock, a little over 10 years. There's limits and rules in there on how long you can wait. I don't know if this is in compliance with that or not, but it's important here that you take note of this date reference here, and that's why you're going to see that there's a big difference. The grant price is $19. That's what he has to pay for it when he exercises it. But on the date of the exercise, Intel was trading on the stock market for $26.2413. This is all make-believe. I don't want you to go and look up what Intel really traded for because this is all fabricated. It wouldn't really have traded for those numbers. But here we've got a trade price of $26.2413 on the date he exercises, and we have an original option price of $19. And if you do the math here, which I'm about to do, you can see that his option cost for purchasing 500 options is $9,500. And the gross proceeds from selling those is $13,120. So if you take those same 500 shares and multiply that by 26.2413, you get $13,120.65. The total gain is the difference between these two numbers. $9,500 from $13,120 is $3,620. Well, does that look familiar? It should, because that's the number that's right here with a code V next to it. So that tells you that Jake Edwards' cost basis is not $9,500. It's actually $13,120.65. So let's go back up and look at the 1099B statement here. What does it say? It says that his cost or other basis is $13,120.65. That makes sense. Now, in the days before cost basis reporting, this would be blank. And we'd be asking our client, okay, how much did you pay for those shares? And they're probably thinking in the back of their mind what their grant price was and what they exercised for. But you do have to bear in mind that when it is a non-qualified option, that the difference between what they exercise for and what they sell for has to get grossed up in their pay. And so in nearly every case, they actually will end up with a slight loss rather than a slight profit. So if you have an exercise of stock options and you're getting a gain, that should have your alarm bells ringing because there's almost never a gain. And the reason that there's almost never a gain is that the law requires the difference between the exercise price and the fair market value be included in the income. And after that's happened, then the basis is the fair market value on the date of the exercise. There's an exception to that rule, and that exception to that rule is if the stock was held but meets all of the rules for being considered a qualified exercise of stock options. And to be a qualified exercise of stock options, you have to have a grant date, you have to purchase the stock, and you have to then hold the stock at least 2 years after the grant date and at least more than 1 year past the exercise date. So if Jake exercises on 10/1 of 12 and then he sells on 10/2 of 13, then it would become a qualifying option and his profit would not be reportable as wages. Most employees do not exercise under the qualified rules. They usually have disqualifying dispositions that don't meet those rules. Here is Jake's finished tax return. We're going to start at the top of page 1 of the 1040 form on line 7. And on line 7, we're showing the income from his W-2, $128,621. We're also showing the interest income that he had, or they had. Remember that Mary had some interest income, and so did Jake. And there's obviously going to have to be a Schedule B because the total of that interest income is over $1,500. We also had dividend income, and all of this dividend income came through from holdings at Barclays of London, $9,630. It's all qualified. Then on line 13, we have $77,979 of capital gain income. Well, to figure where that number came from, we had to obviously do the 8949 and the Schedule D, so those are coming up. We then move on to page 2 of the 1040, and you can see on page 2 of 1040, we're just claiming a small itemized deduction, and if you look at where that itemized deduction comes from, it's simply because the state income tax withholding is large enough that they do itemize. They get 2 exemptions, and then on line 43 we have their taxable income. Well, we're going to have to do a Schedule D worksheet quite obviously to figure out what their tax is going to be to enter on line 44. Here's their Schedule A. The only deduction showing is income tax withheld on that W-2. On the Schedule B, we see that there's $500 from UK National Bank and there's $1,500 from US Bank. The total interest income is $2,000. Barclays issued $9,630 of dividend income, and I wanted to point out a section to you at the bottom of Schedule B. The section is not new. It's been there for as many years as I can remember. But what is new is a new checkbox was put in here, and it's this box 7B. Let's take a look at it. It says Part 3, Foreign Accounts and Trusts. You must complete this part of Schedule B if A, you had over $1,500 of taxable interest or ordinary dividends, or B, had a foreign account, or C, received a distribution from or you were the grantor of or a transfer to a foreign trust. And if any of those apply to you, then you need to check box A. At any time during 2012, did you have a financial interest in or a signature authority over a financial account, such as a bank account, securities account, or a brokerage account located in a foreign country? If yes, are you required to file Form TDF 9022.1? That's the FBAR report, the account for reporting foreign financial accounts that you have control over. So if you have a foreign account, you need to check yes. And if you are required to file the FBAR report, you also check 7B. And then the next question is, during 2012, did you receive a distribution from or were you the grantor of or transfer to a foreign trust? If yes, you may have to file Form 3520. And I've said no for the Edwards, but one of the things I recently discovered, which didn't pop out at me until recently, was that the IRS considers, or the federal government of the United States considers, foreign pension plans to be foreign trusts. So if you're working with international workers, or Americans who've worked overseas, or foreign nationals who've come to work in the United States, and they have work histories in countries outside of the United States, working for companies that have pension plans, it's possible that they do have access to money in foreign pension plans if they have control over those pension plan accounts in a grantor type of relationship over those foreign pension accounts, for example, an IRA in a foreign country. Then you would need to check yes, and if that's the case, 3520 may need to be filed. And the exception to that is if the plan is a Canadian plan, then there's a special form for Canada. I think it's 8891 or 89, something like that, that Canadians have instead. All right, so let's move on now that we've analyzed the bottom of Schedule B. We're moving on to Schedule D. And on Schedule D, we're reporting the sum totals from all of the 8949s. So let's just scoot over to the 8949s and see how those came together. On the first 8949, we're checking Part 1, short-term, Box A, short-term transactions reported on a 1099-B and was showing basis that was reported to the IRS. There was one account that was the case, and that was the Intel account. The Intel account was reported to the IRS on a 1099-B. It showed the proceeds, it showed the cost, and it showed the gain or loss as the $6 that I pointed out. I do see a question here saying, would a government pension plan also be the same as a private plan? The answer is no, because the IRS says that you have to be able to access and control the funds that are within it. So all of the research that I've been able to do on it, and it's really terrible research materials that the IRS provides and absolutely zero assistance that they give over the phone as well. But essentially, if you have the ability to go to that fund and take money from it because you have ownership and control of it, then you would be a grantor and the 3520 needs to be filed. That's what I've been able to establish. But if you call the IRS and talk to the tax practitioner hotline at IRS and you tell them you have some questions about the filing requirements for 3520 and how to fill it out, 3520A, how to fill it out, they'll tell you to talk to a tax advisor. So it doesn't help when you're the tax advisor and you have the question. Basically, they don't help you there. And I went to my congressman's office. My congressman then forwarded me on to some liaisons here in Portland, Oregon. I talked to people all over the country, and no one was able to answer those questions. So if you have some answers, you let me know. I think that the only way you're going to find out, that was what they told me. They said, well, you know what? If you do the 3520A incorrectly, and I'm sure I did, then an auditor will send a letter, and you can ask the auditor all your questions. That's literally what the tax practitioner hotline people told me, so it was very comforting. I let my client know that that would be how it would go. All right, Part 2, long-term. We're still on Jake Edwards here. So what was reported in Part 2 long-term with basis reported to IRS? Well, we had the 100 shares of NM stock and we had 50 shares of IBM stock, and in both cases, the basis was off. In NM, we actually have an actual basis of $4,000, but the basis reported to IRS is $3,000, so we're making an adjustment of $1,000 in column G, and the code that we enter in column F is a B. And for the IBM shares, we also had a difference in cost of $20, And so that's going to adjust the net gain. So if you go column D minus column E, you would get 2,000. But we make the adjustment in column G and then enter the true gain or loss in column H. And the same goes for the 50 shares of IBM, where we result in a $215 loss. As we scroll down the page, you can see down at the bottom we've got the totals, and these totals are the totals that carry to the Schedule D. So you can see line 4, we have 75.80, 57.75, negative 1,020, and 785. If we go back up to the Schedule D, that's going to follow right across here, where we have Part 2 with box A checked. All of those numbers copy straight across. Next in line, we have Part 2 of 89.49 with box B checked. We have 3 separate transactions that were reported here. We just enter the cost basis. No cost basis was reported to the IRS. There's no special reason to enter a code. We just enter the cost basis that we have on record and then carry that over. And again, we have the totals, and those carry to Schedule D. Then finally, we have Part 2 of Form 8949 with box C checked. Remember that land sale? I mentioned it before the break that there was a land sale that went on, and that it was purchased back in 1998, sold in 2012. The proceeds were $100,000. The cost is $20,000, and there's a gain of $80,000. So again, now going back up to the Schedule D, each of these transactions is entered on. We have the ISO shares, the Intel stock option shares that were sold. Those are being reported on line 1. Then in Part 2, we have the long-term transactions from each of those 8949 Part 2s that we completed. So there was no less than 4 8949s prepared for Jake Edwards to report the small number of sales he had, to then move on and enter all of that onto the Schedule D. Clocking through all those forms again. Now it's time to do the capital gain worksheet. So our work's not done. Let's figure these numbers. And of course, the starting point is to enter the taxable income from line 43 of the 1040. And I showed you that a few minutes ago. You'll just have to take my word for it that we had $196,674 on that line. And now the thinking goes on. And line 2, it says, what were the amount of qualified dividends that you reported on line 9B of your 1040? And that was the Barclays of London shares, and that was $9,630 of qualified dividends received there. And then it says, what were your capital gain income? If you filed a Schedule D, check yes if you did, and enter the amount of capital gain that you had. And for Jake, that was $77,979. We're going to add the $77,979 to the $96,030, and we get $87,609. That's the total amount of income that the Edwards have that can be taxed at the lower capital gain rate. And the next step is to take that $87,000 and subtract it from the taxable income that they have. When we do that, we arrive at a number, and that number is $70,700. And then the next step is, of course, we have to determine whether or not we're above or below a certain threshold amount. And if we go over here, we can see $109,000 is their income, and it is above the threshold amount for their filing status. So $96,000 minus $87,609 is $109,065. And now our question is that above or below the threshold amount for their filing status? And the answer is it is well above. That keeps it simple. It means that none of their capital gain income is exposed to the lowest 0% rate. In other words, all of their capital gain income is going to be exposed to the flat 15% rate. And so at this point, it becomes pretty simple. We're going to take the $87,609, multiply that by 15%, and when we do that, we get $13,141. The next step is to figure the tax on the amount on line 7, which is this $109,065. And to do that, we'd actually have to do the tax rate schedules. We won't use the tax rate schedule because the income is too high. We'll have to do the tax rate worksheets and manually figure the tax. But when we do that, we end up with tax on line 7 of $19,326. And then, of course, we take line 16, we add that to line 15, and when we do that, we get $32,467. The next step is to take all of their income from line 1, figure the tax on that using the ordinary tax rates, and when we do that, we get $42,848. Clearly, line 17 is the better deal, so the Edwards are going to take that deal, and they're going to put $32,467 on their 1040. Going way back up here, and we're going to whack that down on line 44, $32,467. Well, that's a heck of a lot of work to figure out one number to enter on one line, but that literally is what you have to do. Oh, we're not done with them. Remember I said that they were going to have to do some extra forms? Here's one of them. It is Form 8938, Statement of Specified Foreign Financial Assets. This is the FATCA report. So these days, when you're working with clients who have brokerage accounts, one of the questions you should be asking, well, any client, whether they've provided you with information on a brokerage account or not, is, hey, do you have interest or control over a foreign financial account? In other words, do you have a bank account overseas? Do you have a pension plan overseas? Do you have money overseas somewhere, any investments overseas somewhere? Because if they do, you're going to have to do some figuring to determine whether or not they are required to file Form 8938 or the FBAR report. And in this case, I threw Jake Edwards' income high enough that he's required to file both of them. The threshold amount essentially for a joint filer living in the United States is $150,000 of foreign financial assets. If his assets are worth more than that, then he needs to file the FATCA form. And if he has over $10,000 in foreign financial accounts, then he needs to file the FBAR report. And in this case, we've got both. And I do see a question. In this example, do you need to paper file any forms to the IRS? I just wanted to make sure I understand mailing versus e-filing. Well, for Jake and Mary Edwards, their tax return is completely e-fileable with the exception of the FBAR report. I'm going to come to that in a minute. FBAR is a separate document. It doesn't even go to the regular IRS service centers. It goes to a special Treasury Department service center in Detroit, Michigan. But the FATCA report that you see here is a part of their tax return, and it is filed electronically with the return. So this is a supplementary page that has to be included with the return. Beginning with tax year 2011, it is mandatory if, for a joint filer, the foreign financial assets total more than $150,000 at the end of the year, half that if you're single. If you live overseas, you could take those numbers and double them. But if you're living in the United States, which most of our clients do, unless you're a tax preparer outside of the United States, we do have a few students who attend our courses from outside of the United States. So if you are residing in a foreign country, such as the UK, taking this course, the FATCA requirements are different for your clients because they are residing outside of the United States. But for Americans residing or foreign nationals residing inside of the United States, whether you're American or a foreign national, if you are living in the United States, then the limits are much lower and the filing requirement is therefore more common. So we have the 8938 for Jake and Mary Edwards, and you will see that we have Part 1, foreign deposit and custodial accounts, the maximum value of the account during the year. I've just told you in the wording of the problem it was $195,008. That's more than $150,000. They have to file the report. And on the report, they're showing the foreign currency in which the account is maintained, the foreign currency exchange rate, the name of the financial institution, and the address of the financial institution where that asset is housed. And then we move on to the second page of Form 8938. And on this page, we actually have to identify the income that came from those foreign financial investments and where on the tax return we reported that income. And we can see that there was $500 of interest income that came from UK National Bank. We've reported that on Form 1040 line 8A, and we've also reported it on Schedule B line 1. And for the Barclays of London's dividends, the dividend income from that account has been reported on the 1040 on line 9A, also line 9B, and then it's been reported on Schedule B on line 5. So we're doing complete disclosure of the foreign financial assets and any income that was coming from those foreign financial assets. We then move on to a continuation sheet, and on this continuation sheet we're identifying the depository account where there's $15,000 for the UK National Bank that issued that interest income. Now you'll notice at the bottom, I think it's the bottom of page 2 of the form, you are not required to file this 8938 form for a particular financial asset if that asset was reported on another form. I'm just trying to find where that's indicated. It's right here. It says in Part 4, accepted specified foreign financial assets. You see this 3520? If the foreign financial asset is a trust or a foreign pension plan, which the IRS considers to be a trust, and you filed 3520, then you would check this box and you would not include that financial information on the 8938. The Canadian form that I mentioned is an 8891, and if your client has a foreign financial account in Canada that is a trust like an IRA, up in Canada they call them RRSPs. If they have an RRSP up in Canada, then they need to file 8991 to disclose that ownership of that account. And if you do that with them, then the 8938 does not also need to be filed or completed. And instead, you would just check this box. And then finally, we've got the FBAR report. We're still not done with the Edwards. And I would say about maybe a third of my clients who have foreign financial accounts want to do these TD forms by themselves. And the others tell me to please do them. They don't want anything to do with it. It's pretty simple once you've got all of their accounts entered into your computer software, because year to year the computer software will remember all of that information. Then you just need to enter the updated amounts or changes in addresses if they occurred. But the first year, my typical client that has a foreign financial account, they typically have more than one. They might have 6, 7, 9, 10 of them, and each of their foreign financial accounts has to be listed on here with the year-end balances and the addresses, and it can be quite nitpicky work getting it all reported. But for the case of the Edwards, the TD form or the FBAR form is only used to report financial accounts like bank accounts. It's not used to report all types of brokerage accounts. FATCA is much broader in terms of its scope of the type of things that get reported on it, but for FBAR you're really looking mainly at bank accounts and trusts, foreign pension plans. So in the case of the Edwards, it's only one account. It's UK National Bank, the $15,000 amount. And therefore, we're just doing a little piece of the FBAR report here, but it can go on for many, many pages if they have more accounts. And actually, I did report that foreign financial account, probably just to play it safe for Barclays of London. I put it on there too. Sometimes it's required, sometimes not. I think if it's a financial account, it needs to be reported. Like if it's in a brokerage firm and they're managing all the money for you, you need to report that. But if you have individual stocks that you are holding and trading, then it's not required. I believe that's the difference. Is the FBAR form required every year? And the answer is the FBAR form is required every year that your client has ownership or control over foreign financial assets. And at any time during the year, the account balance is totaled $10,000 or more. So if your client has an account that has $15,000 in it at any time during the year, even if it was just for a day, because maybe they sold a property, the money went into a bank account, then they emptied that account and they didn't have money in the account at the end of the year, but for that one day during the year it did have money, then they're supposed to disclose that. And it's part of the IRS's effort to crack down on money laundering and also tax evaders who are not reporting their income and paying tax on it. It's part of an overall partnership that the IRS has forced upon foreign nations to require those foreign nations to require their financial institutions to disclose ownership of foreign financial accounts to the IRS that they believe are owned by American residents or citizens. So it's quite a big picture. I do talk quite a bit more about it in an earlier course I taught in our series called Investment, Wage, Tip, and Other Income. And in that class we talk a lot about the rules and who falls under them. But we're not doing much of that here today. Calgary, C-A-L-G-A-R-Y, Calgary. I did ask you guys to take a look at different C questions. It says C question number 1. I've got number 2, number 3, and number 4. And what I mean by C is the special enrollment examination. These are actual test questions that the IRS has placed on its C exams in the past. We've updated them to be current with 2012 law, but other than that, they're verbatim, the way IRS wrote them, and they can be helpful for reinforcing some of the topics covered in today's class. So let's take a look at number 1. Don invested in HoHo Mutual Fund by purchasing 100 shares on March 1st of 2011. On the first day of every month, the HoHo Fund pays a dividend that Don elected to have reinvested into the HoHo Fund. Don received 5 additional shares each month. On April 15, 2012, Don sold his entire interest, 165 shares, in the HoHo Fund. How many of the HoHo Fund shares sold by Don qualify for the long-term holding period? He originally purchased 100 shares. Option number B is the correct answer, and the reason is that the holding period of dividends that you reinvest for the shares that are purchased with those reinvested dividends is the date that the dividends were issued. So if he purchased on March 1, 2011, then on April 1, 2011, he received his first dividend and he used it to buy 5 shares. And then on April 15, 2012, he sells. He would not have had any more dividend reinvestments that were longer than a year. He only had one dividend reinvestment that was more than 1 year, the first one, and that's where we get 105 being the correct answer. Moving on to C, question number 2. In 2010, Bernard received a boat as a gift from his father. At the time of the gift, the boat had a fair market value of $60,000 and an adjusted basis of $80,000 to Paul's father. After Paul received the boat, nothing occurred affecting Paul's basis in the boat. In 2012, Paul sold the boat for $75,000. And what is the amount and character of Paul's gain? The correct answer is D, neither a gain or a loss. And again, we cover this in our class on basis of assets. We look at the rules for that. But when you have a gifted property, the rule for gifted property is that your basis is the same as the donor's basis if you sell at a profit. And if you sell it at a loss, your basis is the lesser of the donor's basis or the fair market value on the date of the gift. And if you have a lower fair market value on the date of the gift than you have basis, and then you sell for a price somewhere between the fair market value and the basis, then you have neither a gain or a loss. And it's just simply a fact that you need to know in your head. It's one of the rules for basis of assets, and that's why D is the correct answer. In fact, I did create a note pod here to kind of explain that rule that I just read out to you, so let's take a look at it. It says, if the fair market value of property at the time of gift is less than the donor's basis, your basis depends on whether you have a gain or loss when you dispose of the property. Your basis for figuring a gain is the same as the donor's adjusted basis plus or minus any required adjustments to basis while you held the property. Your basis for figuring a loss is its fair market value when you received the gift plus or minus any required adjustments to basis while you held the property. And if the sales price is between the fair market value and adjusted basis, you have neither a gain or a loss. And you could refer to page 99 of IRS Publication 17 for more details on those rules. Moving on to the next question, see question number 3. Bob sold securities in 2012, and the sale resulted in a capital loss of $7,000. He had no other capital transactions, and he and his wife Gloria decided to file separate returns for 2012. His taxable income was $26,000. What amount of capital loss can he deduct on his 2012 return? What amount can he carry forward? D is the correct answer, and it's just remembering that brief sentence earlier in today's class where I said that if you have a capital loss, the most loss you are allowed to claim in a year that can offset other forms of ordinary income is $3,000. But if your filing status is married filing separate, then the amount of loss you are allowed to claim is $1,500, and there's only one option here that offered $1,500 as the allowable loss. So if you remembered that rule, it was an easy one to get right. All right, and then question number 4. In December 2012, Angela sold 20 shares of Neely Company stock for $8,000. This was qualified small business stock that she had bought in September of 2007. Her basis is $2,000. What is her taxable gain? And this one's making you think a little because remember we spent a little bit of time talking about qualified small business stock, and you have to look to the year she bought it. She did not buy it in one of those years where she can exclude 75% or 100%. She bought it in an earlier year. I'm telling you that it was 2007 that she purchased it. So it's going to fall under that 50% category, assuming it's qualified small business stock. So as qualified small business stock, she can exclude half of her gain, 50% of her gain from taxation. She'll pay 28% tax on the remaining amount that is taxable. So step number 1 is to figure the gain. If she sells the stock for $8,000 and she originally bought it for $2,000, that means her profit is $6,000. She'll exclude half of that, and therefore option C, $3,000, is the correct answer. What's her taxable gain? $3,000. Let's move on to the next topic of the day, which is sale of business property. And I'm just going to do something real quick here. Back on to the next topic of the day, which is sale of business property. When you dispose of business property, things are a little bit more complicated. Well, maybe not. Schedule D and 8949 are plenty of work all in their own right, but when you move into 4797, I think you are working your way into one of the more complex areas of tax law in terms of really understanding 4797 and how you fill it out and all the rules about what, where, and how gets reported on there. So I'm going to do the best job I can today of breaking down 4797 into all of its component parts so that you can have some clarity for the future on when and how to complete this form. So when you dispose of business property, your taxable gain or loss is usually a Section 1231 gain or loss. The treatment of gains or losses as ordinary or capital is determined under the rules for Section 1231 transactions. When you dispose of depreciable property at a gain, you may have to recognize all or a part of the gain as ordinary income under the depreciation recapture rules. Any remaining gain is a Section 1231 gain. Sale of business use assets are not directly reported on Schedule D or Form 8949, and instead the sale of business use assets is reported on Form 4797. Property that is held, or Section 1231 property, is what we're going to look at a definition of now. So what exactly is Section 1231 property? Property that is held and used in a business for more than a year is generally considered to be Section 1231 property. The sale of a Section 1231 business asset is generally considered to be the sale of a capital asset, and the net gain or loss from the sale is treated as a long-term capital gain or loss. And the following assets are Section 1231 assets. They include Section 1245 property, which is any property that has been subject to an allowance for depreciation or amortization, and Section 1250 property. That's real property. So right now we've described Section 1231 property. Section 1231 property is business use property, and it includes both 1245 property and 1250 property. If you sold 1231 property, you report that on 4797. On 4797, you're going to break down the sale of the 1231 property between 1245 and 1250, not necessarily on the form itself, but how you treat it in terms of reporting gains or losses on the sale are going to be affected and are treated slightly differently on the 4797 when you get to Part 3. Section 1231 gains and losses. Section 1231 gains and losses are taxable gains and losses from Section 1231 transactions. How you treat the sale depends on whether you have a gain or a loss. A net Section 1231 loss is an ordinary loss, and you get to claim it on line 14 of the Form 1040. That's really important because if you have a capital loss, we just saw that the loss that you can claim on line 13 as a capital loss is limited to $3,000 a year. But if you claim a loss on line 14, there's really no limit. Whatever the loss is, you can claim it. So being able to claim losses on line 14 is kind of a big deal. Then we have a net Section 1231 gain. Well, a net Section 1231 gain is treated as ordinary income up to the amount of prior year unrecaptured losses and is reported on Form 1040, line 14. The rest of any gain, if any, is capital gain reported on line 13. So what did all that mean? Well, we're going to go and figure all that out. Firstly, let's take a look at the 1040 and analyze a couple of lines that you may be super familiar with, or maybe you've never paid much attention to the differences between them. And in particular, I'm talking about line 14. Line 13 you should be pretty familiar with. You sell stock, you file a Schedule D, you fill a number on line 13. That's self-evident. But underneath it is this other line, other gains or losses attached Form 4797. And the hows and whys of whether a number goes on one line or the other are quite specific. You report Section 1231 gains on line 13. That's the profit from the sale of an asset that you used in a trade or business. That's reported as a capital gain on line 13. On line 14, you report any recapture of depreciation on the disposition of Section 1245 property, and you also report losses on the sale of Section 1231 property. So remember, 1231 property includes both 1245 and 1250. Well, what I've just finished telling you is that if you have a gain on the sale of 1245 property, that's reported on line 14, but not 1250. The gain from the sale of 1250 property does not go on line 14. Interesting, huh? Okay, so Section 1245 property, let's talk a little bit about it. Section 1245 property includes any property that is or has been subject to an allowance for depreciation or amortization, and which is one of the following types of property. Personal property, either tangible or intangible, and certain other tangible property except buildings and their structural components, as described in IRS Publication 544. When you sell Section 1245 property, any gain resulting from recapture of depreciation is treated as ordinary income. Depreciation and amortization that must be recaptured as ordinary income includes, but it is not limited to, the following: ordinary depreciation deductions, as well as any special depreciation allowance and the Section 179 deduction. Amortization or other deductions as described in IRS Publication 544. And any basis reduction for the investment credit, qualified electric vehicle credit, the alternative fuel credit, and other credits claimed against the purchase price of the asset, minus any basis increase you may have had for a credit recapture. Moving on to the next one, we have Form 1040, and now we're looking at a slight difference here. On capital gain or loss, on line 13, we're going to report gain from the sale of Section 1245 property on this line. And we're going to report recaptured depreciation on Section 1245 property on this line. So in the earlier illustration, we were referring to the sale of 1231 property that can include 1245 and 1250 property. So I'm summarizing the rule for both those types of properties in my description. But when we go down to this illustration, the difference is that this illustration is referring only to Section 1245 property and how you report it. If you have a gain from the sale of 1245 property, that's reported on line 13. Any recapture of depreciation or any loss is reported on line 14. Section 1250 property includes all real property subject to an allowance for depreciation that is not and never has been Section 1245 property. Most leasehold of land and buildings are Section 1250 property. The recovery tax rate for depreciation on Section 1250 property is 25%. You saw earlier in that chart we were looking at with the different types of capital gain rates that apply. One of those rates was for unrecaptured gain, and that was the 25% rate. Well, that refers to recovery of depreciation on the sale of Section 1250 property. The maximum rate of tax you will pay on that recovery of depreciation is 25%. However, that 25% rate applies when your taxable income, less your capital gains, is greater than the numbers that you see here. So if your income is less than these numbers, then the recovery of depreciation on the section of 1250 property is actually just included in your regular income, and you go look up your tax rate using the tax rate schedules. But if your recovery of depreciation puts you in an income higher than these amounts, then the maximum rate is 25%. So you would never pay more than 25%, and it's possible you would pay less than 25%. So let's just suppose you're in the 15% bracket and you have a recovery of depreciation on the sale of a building. You're not going to pay 25% on that recovery if you're only in the 15% bracket. You pay your ordinary rate up until you move into the 25% bracket, and then from the 25% bracket and higher, you'll always be held down to 25% as a maximum rate of tax on the sale of 1250 property. And then on this next illustration of 1040, I'm highlighting line 13. Gain from the sale of Section 1250 property is reported in full on line 13. Regardless of whether or not there's any recovery of depreciation on the sale of Section 1250 property is always reported in full on line 13. You would never report the sale that results in a profit on line 13. But if you sold Section 1250 property at a loss, you could claim the loss on line 14. But typically, most of the time, Section 1250 property does sell at a gain. Non-taxable trades. In general, the only kind of non-taxable trade is a Section 1031 like-kind exchange. Today's class is not really about like-kind exchanges. Later on in August, I'll have an entire hour, a little bit more than an hour-long class. I will teach in that class only about like-kind exchanges and how to complete the 8824. For today, I'm just touching on the rules because I want you to be able to identify a like-kind exchange when you see one and know that you can't just treat it as a normal type of sale. So non-taxable trades. In general, the only kind of non-taxable trade is a Section 1031 like-kind exchange. And the rules for like-kind exchanges are as follows. To be non-taxable, a trade must meet all 6 of the following tests. Test number 1, the property must be business or investment property. Property you use in your business or investment includes things like office equipment, rental property, land. Also, personal property such as your car or your home does not qualify for Section 1031 treatment. So it has to be held for use in a business, and you can't just say, hey, I'm going to sell my vacation home and I'm going to do a 1031 exchange on it so I don't have to pay tax on the sale. Unless that vacation home was actually a rental property, you're not going to be able to do a trade on it, at least a like-kind exchange trade that is not recognized by the IRS for being realized taxable income in the year of trade. Test number 2, the property cannot be inventory or other items held primarily for sale. Merchandise you hold for sale is not eligible for special treatment under Section 1031. Test number 3, the property cannot be stocks or bonds. Separate special rules apply to the sale of stocks and bonds, and you can never have a like-kind exchange of stock and bonds. Test number 4, there must be a trade of like property. There must be an exchange of like property as defined by the regulations, and the following properties are considered to be like. Real estate for real estate. The exchange of city property for farm property or unimproved property for improved property is considered to be a like-kind exchange. So you could take a commercial building and trade it for vacant farmland, and that would be fine. However, real estate within the United States traded for real estate in a foreign country is not considered to be a like-kind exchange. Depreciable tangible personal property can be either like-kind or like-class. This means property need only be in the same general asset class to qualify for like-kind exchange treatment. Examples of like-kind property in the same class include office furniture and fixtures and equipment, so a desk traded for a chair would qualify. Information systems such as computers and peripherals are considered to be like-kind. Calculators and photocopiers are considered to be like-kind. Breeding sheep and breeding goats are considered to be like-kind. So if you're a farmer and you want to trade sheep for goats, you can do that. But I don't think you can trade a cow for a goat. You certainly can't trade a cow for a horse. So there's some specific rules there. Automobiles and taxis are in the same class and are like-kind. But examples of non-like-kind property include a light general truck under 13,000 pounds is not in the same class as a heavy truck over 13,000 pounds. And a breeding horse, according to the tables, who is over age 12 is not in the same class as a breeding horse under age 12. Assets used to produce sugar products are not in the same class as assets used to produce grain products. You should refer to IRS Publication 946 Appendix B for a detailed listing of different class types. And in my course on like-kind exchanges, I actually do go to the NICS classification tables, and they can provide some clarification as well. Either of those sources is acceptable. I don't talk about the NCIS tables here, but I do in our class on like-kind exchanges. Test number 5, property to be received must be identified within 45 days after the date you transfer the property you gave up in the trade. Test number 6, the property to be received must be received by the earlier of 180 days after the date on which you gave your property up, or the due date for your return, including extensions for the year in which the transfer of property occurs. So just looking at things, you have to have a like property traded for like property. From the time you give up your property in a trade, you have 45 days to identify the replacement property. The replacement property is identified by essentially a binding contract to buy or sell the property in that 45-day window. And then you have to successfully close on the sale and take possession of the property within 180 days. Real estate for real estate, like-kind exchanges. Most people think of like-kind exchanges within the context of a real estate for real estate trade. In this context, a rental property owner will want to sell one property and then use the proceeds from that sale to buy another property. And since the owner is very unlikely to find another property owner willing to trade properties, hey, I've got this farm and I want to trade it for your house in the city. Would you like to do that deal? Odds are you're going to have a very hard time finding anyone interested in that kind of deal. So intermediaries are a common solution to the problem. And what happens is with an intermediary, you go to the intermediary and you say, hey, intermediary, I have this farm and I found a buyer. I want you to buy my farm from me and sell it to the buyer I found. And then over here in the city, I found this house I want. I want you to buy that house. You're going to then make this trade happen for me. You're buying my farm from me and then you're going to sell me that house. And the intermediary then perfects a deal where they take ownership of the farm, sell it to this other buyer. They purchase the house in the city from the seller, and then they sell it to you. And so when you're dealing with real estate, that's the most common way that you will ever see a like-kind exchange occur. And if you have a client who involved themselves in a real estate like-kind exchange and they say they didn't hire an intermediary, your little alarm bell should be ringing, because the only other way they could possibly have had a perfected trade is if they actually literally did trade their house for a house owned by someone else directly with that other owner. Car trade-ins. These are a common form of like-kind exchange, but in the tax world, when we think about like-kind exchange, we don't normally think about trading in cars. But of course, every time we take a car to a dealership and we find a new car and we do a trade-in, that's what we just did. We did a like-kind exchange. Whether it's a business like-kind exchange or not is what matters for reporting purposes with IRS. So if you had a business car and you used it in your business and then you traded it for another car at a dealership, you do have a like-kind exchange. And if you do have a like-kind exchange, you would need to file Form 8824 to report that trade. Transfers to spouse. Generally, no gain or loss is recognized in a transfer of property to your spouse. If you receive property from your spouse, your basis and holding period is the same as your spouse's basis and holding period. So for example, let's just say we've got Mary, and Mary works for Nike Corporation, and she's been there for many, many years, and she's acquired stock in Nike that she's held for the past 20 years. And she divorces David.
and David gets half of her stock. Well, what is David's basis in the stock that he acquired from Mary in the divorce? His basis will be the same as her basis, whatever it was she acquired that stock for 20 years ago, and if she kept records for that. Related party transactions. If a gain is recognized on the sale or exchange of property to a related person, the gain may be ordinary income even if the property is a capital asset. A loss on the sale or exchange of property between related persons is not deductible, and if you are selling property to a related person or party, you should refer to IRS Publication 544 for more information. Sale of property that has been changed to business use. This reference comes from IRS Publication 551. If you hold property for personal use and then change it to business use or use it to produce rent, such as a rental property, you must figure its basis for depreciation. An example of changing property held for personal use to business use would be renting out your former home. Basis for depreciation is the lesser of the following amounts: the fair market value of the property on the date of the change, or your adjusted basis on the date of the change. This is something to be aware of right now because coming out of our big bad recession, we obviously had a collapse in the housing market in 2008, and housing prices dropped dramatically. There were a number of people that couldn't afford to live in their homes anymore, and some of them abandoned them, some of them were foreclosed on, and some turned them into rental properties just to have some extra income coming in. Well, they lived much more simply. And when you're preparing a tax return for a person who has a home that they converted to rental use, and they did so in the last few years, you should be really on top of this rule about what depreciable basis you're going to use for them. Because if they bought the house in 2006, say close to the peak of the market for $300,000, and now they're renting it beginning in, say, 2009, odds are in 2009 that the value of that house at the time they converted it to rental use was significantly less than they paid for it. And for purposes of depreciating that house, you're going to be going with the fair market value on the date it converted to business use, if that is the lower number. Sale of property. If you later sell or dispose of property that was changed to business or rental use, the basis of the property you will use will depend on whether you are figuring a gain or a loss. If you are figuring a gain, the basis for figuring your gain is your adjusted basis when you sell the property. But if you are claiming a loss, you're going to figure your basis for a loss starting with the smaller of your adjusted basis, or the fair market value of the property at the time of the change to business or rental use, after accounting for any adjustments for depreciation and improvements, etc. Selling a business. Well, selling businesses doesn't come into my practice every day, but every tax season I'm probably dealing with it in one way or another. Some clients are buying pretty good going concern businesses, and others are buying smaller ones or selling smaller ones. But when you're dealing with the sale or a purchase of a business, there's some specific rules that you should be adhering to, and that's what I'm about to describe here. The sale of a business is not usually the sale of a single asset. Instead, all of the assets of the business are sold. Generally, when this occurs, each asset is treated as being sold separately for purposes of determining treatment of gain or loss. A business usually has many assets, and when sold, these assets must be classified as capital assets. And the sale of a capital asset will, of course, result in a capital gain. Real property used in the business. The sale of real property or depreciable property used in the business and held longer than 1 year results in a Section 1231 transaction. And property held for sale to customers, such as inventory or stock in trade. The sale of inventory results in ordinary income or loss. You must figure the gain or loss on each asset separately, and you must also prepare and file a form called 8594 Asset Acquisition Statement. When you sell or buy a business, both the buyer and the seller involved in the sale of the business assets must report the allocation of the sales price among Section 197 intangibles and other business assets. Both the buyer and the seller should each individually attach their own 8594 to their respective tax returns for the year in which the sale occurred. So if you're the seller of a business, you're going to attach 8594 to your tax return, and you're going to tell the IRS that you were the seller and who you sold to and the value of all of the assets that you sold. And if you are the buyer, you're going to attach 8594 to your return, and you're going to say to the IRS, hey, I bought all of these business assets from this particular seller, and this is the value of the assets that I bought. Additionally, if you are selling your property or assets used in your business, you may be required to file one or all of the following forms. And we start with Form 4797, which is for sale of business property. It's also possible if you engaged in a like-kind exchange, an 8824 would be required. That's a less common form. 6252, that one could certainly come up if you sold your business as a going concern business and you did so under an installment agreement, then a 6252 would need to be attached, and very likely you're going to have to attach a Schedule D to your return as well. This is the 8594 form, and I've filled it out. We've got a customer who has sold the property, and the name of the other party in the transaction is Joe Byers. So we are the seller in this transaction. Sample sale, and who bought it? Well, Joe Byer bought it, and this is Joe Byers' personal information, including his identification number. What was the total sales price of the business assets? It was $199,500, and how were those broken out? Well, if you've ever taken a look at the asset acquisition statement, when you get here to Part 2 and it says what was Class 1, what was Class 2, what was Class 3, you're probably scratching your head and going, good grief, what does that mean? Well, the way you figure that out is you go to the IRS instructions for the form, and when you do that, IRS identifies each class as follows. Class 1 assets are cash and general deposit accounts, including savings and checking accounts. Class 2 assets, examples of Class 2 assets include U.S. government securities and publicly traded stock. Class 3 assets are assets that the taxpayer marks to market at least annually for federal income tax purposes and debt instruments, including accounts receivable. Class 4 assets are stock in trade of the taxpayer or other property of a kind that would properly be reported in income as the sale of inventory. So Class 4 assets are stock in trade or inventory, and those have to be split out from other assets of the business. So for example, let's just suppose you bought a bookstore, and you bought the bookstore as a going concern business. It's going to be full of books that are going to be held for sale, and those books would be Class 4 assets. Class 5 assets are all assets other than Class 1, 2, 3, 4, 6, and 7. And pretty much what's not included in those other assets is most of the stuff you would acquire with a business, if you ask me. Office building, copier, phone system, computer. If you're a farmer, you have breeding cows, or a dairy farm, say. You've got a dairy farm and you use your cows for milk production. That would be another example of an asset held for income production that would not be goodwill or into any of those other categories. And so you'd be looking at those cows, those milk cows, falling into the Class 5 assets. But on the other hand, if you bought raised feeder cows for resale, then those would be Class 4 assets because they would be a form of inventory. And then we've got Class 6 assets. These are all Section 197 intangibles as described in Section 197, with the exception of goodwill and going concern value. And if that's what you sold, going concern value and goodwill are both considered to be Class 7 assets. All right, so looking at this 8594 form, we can see here that we have $159,500 of Class 5 assets. Those are sale of tangible personal and real property that is not inventory. And then we have Class 6 and 7 assets totaling $40,000. And a 4797 needs obviously to be prepared for this particular filer, and we're going to go do that in a couple of minutes. But before we get busy with that filer's 4797, I'm just going to describe the 4797 to you in a little bit of detail. Section 1231 gains are reported on Form 4797 Parts 1 and 3. A net gain is carried to Schedule D and reported as a long-term capital gain. And if you have a loss, the loss is carried to Part 2 of Form 4797 and then is claimed as an ordinary loss on Form 1040, line 14. 4797 is divided into 4 distinct parts, and we're going to take a look at each part in turn. And we're going to begin here with Part 1. You use Part 1 of Form 4797 to report the sale, exchange, or condemnation of Section 1231 property that was held for more than 1 year and for which recapture or recovery of depreciation is not required. Examples of assets or dispositions that would be reported in Part 1 include the sale of office equipment used in trade or business and held long-term. Depreciation is not being recaptured because the asset is disposed of for an amount that is equal to or less than its adjusted basis. Or the sale of real estate used in a trade or business and held long-term, where depreciation is not being recovered because the asset is being disposed of for an amount that is equal to or less than its adjusted basis. And finally, land, sale of land. The IRS instructions for Form 4797 tell you that land should be reported in Part 1. Land is not depreciable, therefore you would never have a recapture or recovery of depreciation on the sale of land, and that's why you would report it in Part 1. Part 2 of Form 4797, it's at the bottom of page 1. So Part 1 and Part 2 of Form 4797 both appear on the same page. That's page 1. And so halfway down page 1, you'll come to Part 2 of the form, and you use Part 2, or examples of the types of things that are reported in Part 2 are described here. You use Part 2 to report ordinary income from the sale of business assets, not reportable in Parts 1 or 3. Asset dispositions reported in Part 2 are generally assets which have been held short-term. However, Section 1244 losses are reported in Part 2 even if they are long-term. Examples of asset sales reported in Part 2 include things like the sale of office equipment used in a trade or business and held short-term. Well, if you know the rules for depreciation, if you purchase and dispose of a business use asset in the same year, you're not allowed to depreciate it. So you would have held it short-term, you're not allowed to depreciate it, so you would report it in Part 2. Sale of real estate used in a trade or business and held short-term, same thing. It's held less than a year. Capital treatment is going to go into Part 2. Ordinary gains from the sale of publicly traded partnership units. That's interesting. Well, I'll explain how that works. It's one of the last topics we're going to cover today, how you would report the sale of publicly traded partnership units in Part 2. And then finally, Section 1244 losses from the sale of a small business stock. To be treated as a small business corporation, the total amount of money and other property received by the corporation for its stock as a contribution to capital and paid in surplus generally may not exceed $1 million. And if that's you, and if you lost your shirt, lost some money on that kind of a small business startup venture, and you were one of those initial startup investors, instead of being limited to the normal $3,000 loss limit on capital losses from sale of stock of $3,000 a year, you could actually claim up to $50,000 of loss if you are any filing status other than married filing joint. And if you're a married filing joint, you can actually claim up to $100,000 of loss on the sale of that stock. And then any remaining excess loss above and beyond those limits would be claimed on Schedule D, subject to the $3,000 a year limit. Moving on to Part 3. Use Part 3 to calculate the recapture and recovery of depreciation or amortization on assets used in a trade or business and held long-term. Gain on the disposition of an asset that is a recapture of depreciation is taxed as ordinary income. Gain on a sale that is a result of increased value or appreciation is taxed as a capital gain. So we're going to do a little bit of a comparison here between Part 1 and Part 3 because the difference between them is quite subtle. Part 1, in here, it doesn't have any space for you to pull out depreciation as a portion of the gain and figure out how much tax or how much of that gain is going to be reportable as ordinary income or be subjected to higher rates, say 25% if it's on real estate. But when you move over to Part 3 of the form, we've got some extra lines here where those lines are asking you to pull out and describe how much depreciation was claimed on a particular asset. And then you do a calculation to determine how much of any of your gain is attributable to a recovery or recapture of depreciation. And then that number will pull down to the bottom of the form. Now, if you're like me, you might be wondering, what are all of these extra sections here about and what are they for? Pretty much I've been able to establish that they almost never apply. They really relate to acres and earlier when we were dealing with non-recovery assets in the Reagan administration and earlier. And I've never had a sale that even caused me to have to go there. But if you do have the sale of some older business assets that were placed in service in those earlier years, like way, way, way back in time, then you might need to be worrying about these lines down here. But for the most part, and the only part I'm going to be spending any time talking about today, we're looking at this Part 3 of 4797 all the way through line 24. We then skip the rest of Part 3 and move down to the bottom where we have line 30, 31, and 32 of Part 3. Now, examples of sales or dispositions that would be reported in Part 3 include the sale of a car used in a trade or business where the sales price is greater than the adjusted basis and depreciation has previously been claimed for the vehicle. Or the sale of a franchise for a profit where amortization has been claimed against the original purchase price. Or the sale of real estate for a profit where depreciation has previously been claimed. 4797 Part 4. This is the last little tidbit. Most of page 2 of 4797 is devoted to Part 3. But at the very, very bottom of the page, you get to this little 3-line section here, which is used to report recapture amounts under Section 179 and 280F when business use drops to 50% or less. You use Part 4 to report recapture of depreciation on property for which a Section 179 deduction has previously been claimed and the percentage business use has dropped to 50% or less. You also use it where you have claimed a depreciation deduction for listed property using accelerated depreciation, and then in a later year the percentage business use drops to 50% or less. Now, income from Parts 1, 2, and 3 of Form 4797 is reported on Form 1040, line 13, if capital gain income, or line 14 if it is ordinary income. However, recaptured income in Part 4 of Form 4797 is always reported on the form where the deduction was originally claimed. So I just finished showing you that for Part 1, 2, and 3, we're reporting income from the sale of a business use asset on line 13 or line 14 of the 1040. But if you have a recapture that's being reported in Part 4 of the 4797, instead of reporting that recapture amount on line 13 or 14, you're going to take it straight back to the tax form you originally deducted on. That would be Schedule C, Schedule F, things like those forms. Here's an example. Income recapture of depreciation from Part 4. In 2011, Max purchased and placed in service a computer in his business that cost him $2,000. He claimed a Section 179 deduction for the full purchase price on his 2011 Schedule C. Then in 2012, Mac's business use of the computer dropped from 100% to just 40%. You're going to have to calculate his recovery amount or his recapture amount as follows. You look to the depreciation he claimed in the earlier year under Section 179. He wrote off the whole thing, $2,000. But if he had just gone straight line depreciation and he applied the rules for straight line depreciation in that year, 2011, his deduction would have only been $200. So $200 from $2,000 is $1,800, and that $1,800 would be reported as other income, subject to self-employment tax. You would report that on his Schedule C. And here we have Part 4 filled out for our client. We can see on line 3 we've entered the Section 179 deduction claimed in the earlier year, the recomputed depreciation that should have been claimed in the earlier year applying the straight line method, and then the recapture amount, $1,800. Detailed illustration of 4797. I promised that this was going to come up. And the assets that you saw earlier on that form 8594. 8594, we've got the sale of these assets, $159,500 of Class 5 assets and $40,000 of Class 6 and 7 assets. Let's go fill out a 4797 and talk about those. And the specifics of those assets that you see there are listed here on this schedule. We have the asset being sold, the date it was acquired, the date it was sold, the cost, the land value, accumulated depreciation, adjusted basis, sales price, net gain or loss, depreciation recaptured at the ordinary rate, depreciation recovery at the 25% rate, and the capital gain or loss. So let's start with the office building. The date acquired was 2009. You can see all of the assets were purchased on the same date. They were all sold on the same date about 3 years later, which is June 15, 2012. The cost of the building, $120,000, and of that, $20,000 is land. Accumulated depreciation is $8,760, and the adjusted basis in the building is $111,240. The building sells for $150,000 at a net gain of $38,760. Is any part of that $38,760 a recovery of depreciation? The answer is yes. $8,760 of depreciation was claimed. That's the recovery amount that could be taxed at a maximum rate of 25%. How much of the difference is capital gain? Well, $30,000. So if you straight go across 120 from 150, we have a capital gain of $30,000. But because of our adjusted basis, we have a gain that also is an extra $8,760 for that recovery of depreciation. On the computer, the cost of $4,000, depreciation accumulated is $3,078. The adjusted basis is $922. The sales price is $500, and it results in a $422 loss. On the copier, we have a cost of $8,000. Accumulated depreciation was $61.57. The adjusted basis is therefore $18.43. It sells for $2,000. We have a net gain of $157. All $157 of that profit comes from recapture of depreciation. On the telephone system, the cost is $10,000. The accumulated depreciation is $62.52. The adjusted basis is $37.48. The sales price is $7,000, and the net gain is $3,252. Is any of that from depreciation? The answer is all of it is a recapture of depreciation. And then on the next line, we have goodwill. The cost is $18,000. The accumulated depreciation is $4,200. The adjusted basis is $13,800. We sell for $40,000. producing a net gain of $26,200, of which $4,200 will be a recapture, in this case of amortization, not depreciation, and we're left with a $22,000 gain. Well, that's a lot of information and a lot of numbers to put in different places and get correct on the 4797. And because it's so easy to do a 4797 wrong, I actually did a double illustration here. I did a 4797 wrong on purpose, just so you could see what it looks like when it's done incorrectly. And then after that, I filled out another 4797 that is done correctly. And I'm going to start by showing you the one that's wrong. And my starting point will be to see if you can figure out what's wrong with it. So I'll let you look at it for a couple of minutes. So here is the 4797, and you will see that I've started with Part 3. One of the rules for 4797 is that you probably need to start with Part 3 and then move back over to Part 1. And it's just when you fill the form out, that's the way the numbers flow. So in my illustration, I filled out Part 3 before I have filled out Part 1. But just looking at Part 3 here and thinking about the assets that are in this business, do you see anything that might be missing in Part 3? So what asset is missing from Part 3 that belongs there? The correct answer is goodwill. Let's go see why. I'm just going to scroll back up here and look at that sales schedule again. And take a look. Remember the rule for 4797 Part 3 is that you report in Part 3 any assets used in the trade or business for which amortization or depreciation has been claimed, and essentially part of the profit from the sale is going to be a recapture or recovery of depreciation or amortization. And if you go across the line here, you can see the cost of the goodwill is $18,000, but we do have accumulated depreciation, and in this case it's actually amortization of $4,200. That needs to be reported in Part 3, and because it's not, the whole 4797 is going to get us to a point where we calculate the wrong tax. Using those capital gain worksheets that we've looked at earlier, we have an even more complicated capital gain worksheet coming up in a minute that I will show you. And if you get the numbers on 4797 in the wrong parts, you're going to get the wrong tax when you're done. Now, the other asset that we're dealing with is this office building, and this is a real technical issue. If you read the IRS instructions for 4797 down to the letter, the IRS says that land, the sale of land, is always reportable in Part 1. And my thinking is, well, if the land and the office building are purchased and sold as a single unit, is it really necessary to break that out? I've called and talked with IRS auditors about it, and they've said they don't really care. Technically, it belongs in Part 1, but if you left it in Part 2, it really wouldn't affect the end results of the calculation. Putting goodwill in the wrong place does affect the calculation, but putting land in Part 3 when it really belongs in Part 1 would not affect the calculation. But just to be a perfectionist, because I try to be as perfect as I can, even though I rarely achieve it, I try. The other problem that I see with this particular scenario is that the land has not been separated from the office building. You can see we've got the full sales price of the office building here, including the land value. And in my mind, technically speaking, the land should be broken out. Now, a lot of it just depends on your computer software. If in your computer software, your software puts land on the same line of the depreciation schedule and just subtracts it out of basis, then when you trigger a 4797, it's going to carry all of that as a combined unit to the same line of the 4797. But if in your computer you listed land separately, pulled it out of the cost basis to give it a separate line on the depreciation schedule, then when you tell your software to trigger the sale, then the land should easily carry to the line that it should be entered on, which is Part 1 of Form 4797. So let's just take a look at what's really going on this 4797 in the incorrect version and break it down and analyze it. We've got here the office building, the copier, the telephone system, and those are reported in column A, B, C. So the office property is property A, the copier is property B, and the telephone system is property C. We then list the sales price of each of these assets, and we list the cost basis of each of these assets. Then on line 22, we enter the depreciation previously claimed on each of those assets. Then we get to a point where we calculate gain. And you can see that the gain on the sale of the real estate is $38,760. The question is that more than the depreciation previously claimed? And the answer is yes. And so what that's telling us right now is that of the $38,760, $30,000 is capital gain, and $8,760 is going to be recovery of depreciation. Moving over to property B, we have depreciation that was previously claimed of $6,157, the gain on the sale is much less than that, and therefore what gain we have is going to be completely attributable to the depreciation. $157 is all attributable to recovery or recapture of depreciation. And then on the telephone system, same thing. We buy for 10, sell for 7. We have $62.52 of prior depreciation, leaving an adjusted basis of $67.48. We sell for $32.52. And we're going to enter the smaller of our prior depreciation claimed or the gain, and we're going to get $32.52. If we take these two numbers, 157 and 3252, and we add those together, we get 3409. And if you follow the tax form down, you actually need to enter that number on line 31. We then look to the value of all of these assets. If you take, or the gain on all of these assets on line 24, if you add them up, 38,760 plus 157 plus 3252, you add all of those numbers up and you get $42,169. And that carries to $42,000 to line 30. Why is the property A different than property B and C in your determination of taxes? Well, property A is section 1250 property, and properties B and C are 1245 property. And so the depreciation that you recover on the sale of 1250 property gets entirely different treatment than depreciation recaptured on the sale of 1245 property. And the whole point of Form 4797 is to divide those out, separate them out so that they can get their different tax treatments. And so that was an excellent question to ask. Why is there a difference? Because there is a difference, and it has to do with the class of property they are. So we are going to carry the total gain from the sale of all of the assets reported up here on line 19 through 24 and carry that to line 30. And then we're going to subtract from line 30 these two gain amounts right here in green and enter those on line 31. And what we're left with on line 32 is capital gain from assets reported in Part 3. And line 32 says, okay, take this number, all of this work we just did here, and enter that in Part 1 on line 6. And line 31, it says, take this number and put it on line 13. And to do that, you have to go over to page 1. So that's why I say that in order to do page 1 of Form 4797, you have to start with page 2. So we've done page 2. Now we're going to go over to the computer and the goodwill and enter those. And the goodwill, by the way, is on the wrong line. It doesn't belong here. And that's an important distinction. We're going to see why it creates a problem. The computer has a gross sales price of $500. The depreciation was $3,078. The cost basis was $4,000. So we have a loss on the sale of the computer of $422. On the goodwill, we have a gross sales price of $40,000, depreciation that was allowed of $4,200, and a cost or other basis of $18,000, resulting in a gain of $26,200. Now, if this goodwill were reported on Part 3, as it should be, we would be pulling this $4,200 and adding it to this $3,409 amount we calculated on the earlier page. But because we've reported it on line 2 on page 1, it's not going to do that. Just the math of the form and how the computer entries are going to carry numbers to specific lines of the Schedule D worksheet and to the Form 1040, it's not going to get calculated into income and have tax calculated on it correctly. But at any rate, I've put it here just so you can see the follow-through of how it all comes together. We have the loss on the computer, we have the gain on the goodwill, and we then take these numbers and add them up. On line 7, it says combine lines 2 through 6. Well, 6 is the capital gain income from Part 3, and 2 is the capital gain income from Part 1. We add those amounts, and we have $64,538. That's the capital gain income, and we now have two numbers that we need, and they're going to carry to the 1040. The capital gain income from line 7 will go to 1040 line 12. And the ordinary income, recapture income, on line 18B here of 3409 will carry to, it's supposed to be line 14 and line 13 highlighted. My little color bars have moved. So line 14 is this number on line 18. And line 13 is the 64,538. That's a little bit disorienting. But 64,538 carries to line 13, and 3409 carries to line 14. Questions from the attendee. If you sold more than 2 or 4 assets, what do you do because you run out of space? You would type C statement. And on the statement, you would provide all of the information for each and every asset that you sold, just as you see it listed here. And then I see another question. Would all losses come from page 1 of 4797 and be carried to Form 1040, line 13? Losses are not carried to line 13 on sale of assets at a loss through 4797. They actually carry to line 14. So let's move over and take a look at the Section 1250 gain worksheet next. A Section 1250 gain worksheet is required whenever you have a recovery of depreciation from the sale of real property that you are including in income. It's kind of a mundane worksheet and a waste of time if you ask me, but it's just to point out that if you did sell real estate and you have a recovery of depreciation in there, you need to identify what that recovery amount is so that you can then enter that recovery amount on Schedule D on page 2. So earlier when we were looking at Jake Edwards and his tax return, we prepared a Schedule D for that. We never really did look at page 2 much, but at the top of page 2 you have the capital gain income for the filer. And then on line 19, you're going to enter any portion of the capital gain income that is attributable to a recovery of depreciation on the sale of Section 1250 property. And in the case of our filer here, it's $8,760. And all of that's important for when we get to the next baby of all forms, which is the Schedule D tax worksheet. And isn't it a lovely one? It's got no less than 37 lines that we need to work our way through. So let's go do that together. We start on line 1 by entering the taxable income from the 1040, line 43. And I haven't shown you this filer's 1040. You just have to take my word for it that, well, that's his taxable income. But that's the starting point. We then, on line 7, enter the capital gain income from line 16 of Schedule D. That's the capital gain income that we figured on his $47.97 and then flowed through to the Schedule D. And there's a problem with this number because it contains a certain portion of the recapture of amortization on the goodwill that it should not. This number is too big. And because it's too big, we're going to calculate too small a tax for this filer. Then on the next line it says, subtract line 13, this line here, from line 1. But let's go through and see what happens. On line 7, we enter $64,538. That's the total capital gain income. We need to subtract from that the portion of the gain that is attributable to recovery of depreciation on that business or office building. And when we do that, we're left with $55,778. So that's the amount of capital gain that's pure capital gain. The maximum tax rate that would be paid on that is going to be 15%. We then say, okay, what is line 13 from line 1? And when we do that, we get $38,301. Now we go and look at the filer's threshold number for their filing status. In this case, we have a single filer. The threshold amount is $35,350. This number here is $38,301. Well, that tells us that we're going to have most of the capital gain income or all of the capital gain income being taxed at the 15% rate, that he's not going to qualify for that 0% rate. That's the first thing that that line tells us. But there's another computation going on as well. So line 15, this is the income level at which a single filer moves into the 25% tax bracket. And because the filer's ordinary income places the filer in the 25% bracket, none of his income is eligible for the lower 0 rate. We're going to carry this amount to line 19 right here. And then we look up the tax in the tax tables and enter that on line 34. So that's where this 4874 comes. Look this number up in the tax tables, figure the tax, and enter it on line 34. Next, on line 24, we take the capital gain income, not including the recovery of depreciation, and multiply that by 15%. And when we do that, we get $8,367, and we enter that on line 24. Next up is line 25. And on line 25, we're going to figure how much tax is going to be owed on the $8,760. But there's a little bit of his income that's putting him below the 25% rate. You see this number here, $35,350? Well, if you take the $8,760 subtracted from the $38, you've got a number that is going to push you under this number. What's relevant about that is that not all of the recovered depreciation will be taxed at 25%. Some of it's going to be taxed at his ordinary rate because his ordinary rate is less for a certain portion of that gain. So we take the $8,760, and then we do some computations going on. And I have notes here to explain them because it's all kind of complicated. But on line 25, we are going to figure tax as $738, and we do it this way. We take lines 10 and 19, which is this income here is capital gain income, and then we take line 19, which is this number right here, $35,350. That's the base amount for his filing status. We take those two numbers and we add them together, and then we enter those on line 26. And when you do that, you get $99,888. You then take the amount from line 1 up here, and you can see that that's a lesser number, $94,079. Well, the difference between this number and this number is $5,809, and $5,809 is the amount of gain on the sale of that real estate that is going to be taxed at its ordinary rates and not 25%. When you subtract $5,809 from $8,760, you get $2,951. You multiply that by 25%, and you get $738. If that's confusing to you, the only thing I can say is after today's class is over, just spend some time reading it and absorbing it. And if you spend enough time staring at it, it'll probably ring home. That's what I do. If I stare at it long enough, then I'll figure it out. But we're getting to a point now where things are coming together. We've got capital gain income that we're figuring here. We've got the 25% recovery rate that we're figuring here. The element that we already figured out also is the tax on this remaining $35,350 of income, and we've entered that here, $4,874. So now's the point where we add those numbers up, and when we do that, we get $13,979. We also need to still go to the tax tables because that's what IRS tells you need to do. You take this $94,079, go to the tax tables, figure out the tax, and you can assume, of course, that it's going to be a higher number, which it is, and you get to claim the lower number. When you claim that lower number, you're going to put it on line 44 as the tax computed. And by the way, this is the wrong tax because we did $47.97 wrong. This number's wrong. So let's go on to illustration number 2 where we did it correctly and see the subtle differences in how they play out for us. In this model here, we've got the office building, the copier, the telephone system, and the goodwill all reported where they belong on part 2. And as before, you can see that the recovery of depreciation is shown on line 22, but it does not carry down to line 25B. But the recapture of depreciation on the section 1245 property all the way across is carried over to line 25B. And now we've got an extra $4,200 appearing on this line. So the gain attributable to the recapture of depreciation on section 1245 property now correctly includes an additional $4,200. So line 31 just increased to $76.09, up significantly from where it was earlier in our prior illustration. The rest of the gains going on here are going to work out to be roughly the same numbers, but because we have capital gain being reported here rather than on page 1, we're going to end up with total capital gains that are down by as much as the recapture of depreciation has gone up. Total gains are the same, it's just how they're taxed that is different. So on line 24, we take these numbers all up, all the way across, 33,760, 157, 3252, and 26,200. We add them all up and we enter that total on line 30. We then subtract out the recovery of depreciation on the sale of the office building, and we entered that on line 31. Now, another thing you will notice is that just to be a perfectionist, I did pull out the land values. So the overall sales price for the office building has dropped from $150,000 down to $125,000, and I just did a proration based on purchase price and allocation of purchase price. I did the same percentage allocation for the sales price, and so we have a cost in the building, we have a sales price for the building, and I've now placed the land on part 1. Doing that doesn't change any tax calculations, so having it on the wrong line is not as big an issue. But again, I wanted to have things where they belong, and so that's what I did. So moving on down the form, we've got a total on line 32, which is line 31 from line 30. So you take 63,369, subtract out 7609, and you're going to have 55,760. And this 7609, by the way, goes down here on line 14. And this number up here of 8760, that's going to be a number that we deal with when we get to the worksheet and Schedule D. Moving on to page 1, because we have to do page 2 before we do page 1, we now have on the front of the return, we have the computer and the land reported, but we don't have any amortization or goodwill being reported on part 1, which is correct. And on the land, we had a gross sales price of $25,000. We had a cost of $20,000 and a gain on the sale of the land of $5,000. We have a loss on the sale of the computer of $422. We're going to take these two numbers and we're going to add them to the gain from page 2 on line 32. And when we do that, we get $60,338. That $60,338 is going to carry over to line 13 of the Form 1040. And the recapture of depreciation number 7609 is going to carry to line 14. Line 7, and it's highlighted in yellow. I'm going to follow that down to line 13, which is highlighted in yellow. And the amount highlighted in yellow is total capital gain income. That's going to get capital gain treatment on line 13. And the recapture of depreciation in blue is going to get ordinary tax treatment. It's included on line 14 as income. Let's go over to the Schedule D worksheet now. And to help you kind of follow where I'm at, the orange box on the side here is going to meet up with this orange box here for description purposes. And that's just to help me as I'm teaching, but it could also help you follow along if my pointer isn't exactly where it needs to be. Line 7 and 9 and 10, that's here, 7, 8, 9, and 10 in the orange box. The amount of capital gain income on Form 4797 and Schedule D is reported here. And then out of that, on the purple section, line 11 and 12 are going to subtract out the recovery of depreciation. No part of the recaptured depreciation ever appears on the Schedule D worksheet. It's already been entered on line 14 of the 1040. So all we're dealing with on the Schedule D worksheet is separating out the different types of capital gain income that we have. And we have two kinds of capital gain income. We have straight capital gain income taxed at a maximum rate of 15%. And then we also have recovery of depreciation on the sale of Section 1250 real property taxed at a maximum rate of 25%. And we're going to be using the Schedule D worksheet to break out ordinary income from capital gain income, from recovery income, and figure the tax separately on each of those. So the first step is to enter the capital gain income. We then subtract out the recovery income, and we get $51,578. We then subtract $51,578 from the taxable income of the filer, and we're left with $42,051. Then in part 15 or line 15, just moving down the form, the instructions here say income threshold. Look for the income threshold of the filer. This filer is single, so we're going to be pulling out $35,350. Income higher than this places the filer in a 25% or higher bracket, and clearly this filer is in a 25% or higher bracket. But part of the reason they're in a higher bracket is because of that recovery of depreciation. And so we're going to have that recovery of depreciation pull through. You'll see that line 20 is blank. It's highlighted in green. And the instructions for green say that no capital gain income is eligible for the 0% rate, because after we do the math in this line 15 peach section, there is no 0% rate eligibility. Line 20 ends up being blank. On line 21 through 24, you begin on line 21 by entering $51,578. That's the number from up here. That's capital gain income minus the recovery of depreciation on the sale of the building. And after you have done that calculation, the $51,578 is going to be taxed at a rate of 15%, and that's precisely what then happens. You take $51,578, you multiply that by 15%, and then on line 24, you're going to enter 7737s. Then on line 25, moving on down the form, right here, you're going to enter your 8760, which is the depreciation that was claimed. And now we're doing that similar math computation that we did earlier, trying to figure out whether any part of the ordinary income is attributable to a recapture of depreciation on that office building. And yes, a piece of it is. The part that is recovery of depreciation that is included in ordinary income, the math gives us $1,609. We take $1,609 and we subtract that from $8760, and when we do that, we're left with $7151. That $7151 is then multiplied out by 25%, and we get $1,788. We then figure the tax again on the amount on line 19, and that was $4874, and now we add the numbers, $7737, $1,788, $4874. We add those up and we get $14,399. That's less than the tax that we'd get from the tax tables, and so we end up with $14,399 of tax. All right, what's the summary I've got to say about this? Well, the summary is that in illustration number 1, we have too little recapture of depreciation carrying to line 14, and therefore too much income is being given those capital gain rates. In illustration number 2, everything is reported where it belongs, and when we're finished calculating the differences in tax, illustration 1 gave us $13,979 of tax, and illustration number 2 gives us $14,399 of tax. That's a difference of $420, and we're not dealing with, huge differences in the amount of income left off, where the amount of income reported in the wrong place was only $4,200, but it resulted in tax being off by $420. Let's get on with the rest and last part of today's lecture, which is going to be firstly looking at what happens when you sell a car. where you claim the standard mileage allowance instead of depreciation because, of course, there's something complicated about that we have to deal with. And then we're going to look at publicly traded partnerships and what happens when you sell ownership of units in a publicly traded partnership. And you might think of the sale as units in a publicly traded partnership as something that belongs on Schedule D, and well, it does, but it also involves, unfortunately, completion of 4797. So I didn't teach it earlier in the class. I waited until I was done with 4797. So moving on, we've got reporting the sale of a vehicle used in a trade or business. If you sold or otherwise disposed of a vehicle used in your trade or business, you generally need to report the sale on Form 4797. And this is true regardless of whether you claim the standard mileage rate or actual expenses. Figure and gain where the standard mileage allowance was used. If you used the vehicle for business use and you claimed the standard mileage allowance, any subsequent disposition of your vehicle will result in the disposition of a business asset for which depreciation has been claimed. So yes, even though you're claiming the standard mileage allowance, you still have to deal with depreciation. For 2012, 23 cents of each 55.5 cents per mile is allocable to depreciation. You follow these steps to figure the amount of depreciation you claimed on a vehicle for which you claimed the standard mileage allowance. Firstly, you determine the number of miles driven for business each year, and then for each year the standard mileage rate was claimed, multiply the number of business miles claimed by the standard mileage depreciation rate for that year. We begin with the standard mileage rate for 2012. 23 cents of every mile you claim in 2012 is for depreciation. In 11, it was 22 cents. In 2010, it was 23 cents. And as you go back through time here, you can see that the amount allocable to depreciation over time has been rising. And here's an illustration of how all of that would work. In 2010, you purchased a car for use in your business for $20,000. You drove your car 10,000 business miles in 2010, 5,000 business miles in 2011, and 7,000 business miles in 2012. During 2012, you sold the car for $10,000, and the total mileage for the car is shown for each year in the following chart. So for 2010, the total miles, personal and business, that you put on the vehicle were 15,000. 2011, it was 9,000 miles. In 2012, it was 11,000 miles. So the total miles you put on that vehicle during the time you owned it were 35,000. And the total business miles that you put on the vehicle during that same time was 22,000. So what's your percentage business use? Well, 22 divided by 35 is 62.86%. Then we look at the depreciation claimed each year. 10,000 business miles times 23 cents per mile in 2010 is $2,300. For 2011, 5,000 times 22 cents a mile is $1,100. And for 2012, 7,000 times 23 cents a mile is $1,610. We add up all of the prior depreciation claimed for that vehicle and we get $5,010. So the first step is to figure out the business use percentage. We've done that, 62.86%. Then we have the total business use basis of the vehicle, and we're going to basically start with the purchase price, which up here I tell you is $20,000. We're going to multiply that by 62.86%, and when we do that, we get $12,572. So for purposes of calculating basis, the business use basis of the vehicle, that's the methodology that I have applied. Take the portion of the vehicle that's business, multiply that by the purchase price, and you've got the business use cost in that vehicle. Now we have to figure the adjusted basis for the business use portion of that vehicle. We're going to take $12,572 and subtract the depreciation we figured, $5,010 from that number. And when we do that, we get $7,562. Next, we have to use that same formula, 62.8% business use, and apply that to the sales proceeds. If it sells for $10,000, 62.86% of the sales proceeds equals $6,286, and that is the amount of income we have from the sale, or the gross proceeds attributable to the business. So now we're going to take the 6286, we're going to subtract the outstanding basis, or the remaining basis that we have left, and we actually have a loss on the sale of the vehicle. And where would that loss be claimed? Well, firstly, we'd figure the sale on 4797, and then we'd carry the loss to line 14 of the 1040. So this little table summarizes it all. We take the cost basis, we multiply it by the business use percentage. we get the business use basis. We subtract out accumulated depreciation to get the adjusted business use basis. We take the sales price, we multiply it by the business percentage, and we get 62.86. We take 62.86, subtract 75.62, and we're left with a loss on the sale of $1,276. And finally, here is the last topic of the day, publicly traded partnerships, or PTPs. I can tell you these are not one of my favorite things. When a client comes in the door with a PTP, it's like, oh, brother. Brokerage firms love PTPs. They seem to give higher rates of return. They say that they perform much better than traditional stocks, and so brokerage firms love them. But when a client comes into a tax preparer and brings this brokerage statement and a bunch of K-1s from these publicly traded partnerships, and some of the units in those partnerships were sold during the year, it's like, oh my gosh, that's a lot of work, especially if your software is not really adept at dealing with it. And Drake software certainly is an example of software that's really not been designed to cater to the needs of the reporting required for these stocks. But let's see what it is that you need to do. Section 7704A provides generally that except as provided in that section, a PTP is treated as a corporation. So it's traded on stock exchange like a corporation. It has similar treatment to a corporation in terms of if you're buying, selling in units, that it's going to be capital gain or capital loss. But a PTP is a partnership whose interests are traded on an established securities market, and ownership interest in a PTP takes the form of units rather than shares. These units are traded on the stock market in much the same way that corporate stock is traded. If you buy PTP units, you then become a limited partner in a PTP. There is a tax-free return of capital that typically comes to people who hold units in PTPs. Most PTPs pay a regular quarterly cash distribution. However, because PTPs are not corporations, they do not pay corporate tax, and instead all tax items pass through to the partners. PTPs usually treat the distributions as a tax-free return of capital. A return of capital is not taxable, however, it does reduce basis in the partnership units. Passive activity loss rules limit the amount of losses. If you own interest in a PTP, in all likelihood you are not an active participant in the operation of that PTP. You're just a passive investor, and therefore you're going to be subject to the limits on passive activity losses. So if a PTP has a loss for the year, the loss is considered to be a passive activity loss. The passive activity loss limits require that the losses be carried forward each year until the PTP either realizes a profit or the partner disposes of his or her entire interest in the partnership. And losses from one PTP are not allowed to be used to offset losses from any other PTP or any other income from other passive activities. So we'll be discussing passive activity loss limits and the rules for passive activities in the very next class I'll be teaching next week. It's called Rental Property and Passive Activity Limits. We're going to get into the rules about passive activity losses and how they are limited and how they do carry forward and so forth. But most of those rules talk in general about passive activities and not specifically about PTPs. When you get into PTPs, the rules are slightly different. They're actually more restrictive. In the case of a PTP, you're only allowed to claim a loss that you experience on a PTP when you actually sell that PTP in its entirety, or at some later point you sell units in it that produce a gain, or you actually have a gain from that same PTP. Any of those would allow for some loss at some time to be claimed, but never against any other form of PTP or other income. Sale, exchange, or other transfer of partnership interest. A net passive loss from a PTP may not be deducted from other passive income. Instead, a passive loss from a PTP is suspended and is carried forward to be applied against passive income from the same PTP in future years. If the partner's entire interest in the PTP is completely disposed of, any unused losses are allowed in full in the year of disposition. And those instructions on that can be found in the Partner's Instructions for Schedule K1, Form 1065B. One of the things I have to tell you about this particular part of the class, publicly traded partnerships and how to report those on a tax return, is the IRS doesn't have any single one place that you can go to sort of put it all together and figure out what to do. And when I came down to the point where I was trying to figure out what to do for units that a client of mine had sold in a PTP and how to actually deal with those on the tax return, I was getting a little bit agitated because I couldn't find the instructions all neat in one place with illustrations all filled out the way that I wanted them to be. So finally I called the tax practitioner hotline at the IRS, and the people I talked to didn't know either. So then they put it over to their special research department, and I finally got a phone call back from an auditor who was familiar with publicly traded partnerships, and she knew all of the answers to my questions in her head. And I said, okay, that's just wonderful that you know the answers to my questions in your head, but where are they in the instructions? And what you'll find is that they're not any one place in the instructions. Some of the information I'm giving you today comes from IRS Publication 541, Partnerships, page 11. Others come from the Partners Instructions for Schedule K1 on page 5. There's some good information there. And other information comes from the instructions for Form 8582. You really have to piecemeal it all together, and so I've done the best job I can in today's class of piecing all of those parts together and doing an illustration for you. All right, so just so you know, the sale or exchange of a partner's interest in a partnership does usually result in a capital gain or loss, but when you're dealing with the sale of a PTP, you're going to have to do some fancy footwork to calculate exactly how treatment of that gain or loss is going to work. Section 469K provides that the passive activity limits must be applied separately to items from each PTP. And generally, the losses from a PTP may be used only to offset income or gain from passive activities of that same PTP. What I'm reading you from here, this paragraph down here, points 1 through 3, comes from page 5 of the Partner's Instructions for Form 1065K1. Do not report passive income gains or losses from a PTP on Form 8582. Instead, use the following rules to figure and report your income gains and losses from passive activities you held through each PTP you owned during the year. Well, my clients who have ownership in PTPs, they usually have half a dozen of them that I've got to work my way through each year. I've got one client who I think has about 10 of them, and every time I turn around, he's dropping off another K1 in my office. I don't even start his tax return until about April 10th because I know he's going to have another K1, and I hate revisiting things. I want to get it all done in one shot. So after he's been delivering documents to me for really most of the tax season, starting, in early February all the way through March, right around the 10th of April, I'll pull his file, stick it on my desk, and I'll do the whole thing in one shot because I know I have everything finally. These K1s do trickle in, and they can create complications if you don't have them. So firstly, let's look at these rules here. Combine any current year income gains or losses and any prior year unallowed losses you see if you have an overall loss from the PTP. Include only the same types of income and losses you would include to figure your net income or loss from a non-PTP passive activity. Okay? Point 2, if you have an overall gain, the net gain portion, that total gain minus total losses, is non-passive income. Well, that's weird. So if you have a gain on a PTP, that's non-passive income. But if you have a loss on a PTP, it is passive income. And that would mean that gains from PTPs can't be used to offset other passive activity losses. That would be the point of it. And if you have a passive activity loss, not only can it not be used to offset non-passive activity income, it's only going to be allowed eventually when you actually have income from that same PTP. So if you have an overall gain, the net gain portion is non-passive income. On the former schedule you normally use, report the net gain portion as non-passive income and the remaining income and the total losses as passive income and loss. To the left of the entry space, enter Form PTP. Okay? If you have an overall loss but did not dispose of your entire interest in the PTP to an unrelated person in a fully taxable transaction during the year, then the losses are allowed only to the extent of the income, and the excess loss is carried forward to use in a future year, if you have income to offset it. Report as a passive loss on the schedule or form you normally use the portion of the loss equal to your income. Report the income as passive income on the form or schedule you normally use. Well, if that's just crystal clear to you, that comes from the IRS instructions for 1065K1. That's the partner's instructions. So you're the partner, you've got a K1. You read these instructions so you understand what to do with the numbers on that K1. That's literally what they say. Here is one example that is provided in those instructions. It's an activity with an overall loss. You sell your entire interest in an oil or gas limited partnership that was your only passive activity for a gain of $2,000. You have a current year Schedule E loss of $3,330 and a Schedule E prior year unallowed loss of $1,115. Enter the net current year loss plus the prior year unallowed loss. So you're going to take $3,330 plus $1,115, and you get $4,445. You're going to enter that on Schedule E in Part 2 on Column H, and the $2,000 gain on the sale is entered on Form 8949 in Parts 1 or 2, depending on how long you held that partnership interest. Okay, in order to make sense of that, you're going to have to sit down and look at line numbers and maybe even try and fill this illustration out. Something I didn't do for you because I did something better, coming up in a minute. Example, income from the sale of units in a PTP is used to offset suspended losses. This illustration also comes from the partnership instructions, page 5. You have a Schedule E Form 1040 loss of $12,000, current year losses plus prior year unallowed losses, and a Form 4797 gain of $7,200 from the passive activities of the PTP. Report the $7,200 gain on the appropriate line of Form 4797. On Schedule E, on line 28, report $7,200 of loss as a passive loss in column F, and then carry forward to 2013 the unallowed loss of $4,800. If you have unallowed losses for more than one activity of the PTP or from the same activity of the PTP that must be prorated on different forms, you need to allocate the unallowed losses on a prorated basis. All right, so I promised you an illustration. This illustration is one based on a real client's return. And I took all of the documents that had been provided to me by this client that were issued to him by the partnership, the publicly traded partnership. Obviously changed a few things around to make it all anonymous and turned it into a tax school problem. And the character in our story is called Magic Debut. And he sold units in the publicly traded partnership NSH Transfer Partners LP. He has prior year unallowed losses from NSH of $6,044, and he received the following K1 and other year-end information from the PTP, as shown next. NSH Transfer Partners provided Magic with the following transaction schedule, which you see right here, and a sales worksheet, which includes instructions for figuring his gain. Isn't that nice of them? So we move over and we can see that the partner's name is Magic Debut, and you can see in orange here we have, or the peach color, that Magic started his year owning a total of 2,700 units. If we add up all of the units he has here, at the start of the year he had 150 units, and then during the year these are the individual sales that he had. He sold 2,550 units, so at the end of the year he has 150 units. So since these are traded on securities markets, he's going to have a 1099-B reporting the sales. We then move over, and of course he got a K1 because he's a member in a partnership. He's going to get a K1. And we can see on line 1 that the K1 is reporting a partnership loss of $5,502. Since this is a passive activity, his loss will only be allowed to the extent he has income from the same PTP. But he sold units in the PTP. Did they result in a gain? And if they did result in a gain, maybe this loss will be allowed. He also has some interest income and dividend income. Well, these amounts are fully taxable, and they will flow through to line 8 of his 1040 and line 9 of his 1040, where he normally reports interest and dividend income. On line 11, we can see some other form of portfolio income down here, $2. We don't really need to know what it is. We just know that it's income. And the important thing about these income items is that these do affect his basis. So whenever you have an income or a loss item showing in these boxes, it usually has some effect on his basis in the partnership. We also see here on line 19 distributions. Magic Debut actually received $9,028 of distributions from the partnership during the year, and that's what this amount is reflecting, and that would reduce his basis in the partnership. Over on column L, we can see this is the partner's capital account analysis. And this analysis account is maintained by the publicly traded partnership. The PTP maintains this account, but at the same time they're maintaining the account, they're also telling the taxpayer that they're not technically responsible for doing that it's the taxpayer's responsibility to maintain proper records to verify what their basis in the account is. If your client's really on the ball, they may have done that. If they're not on the ball, they probably didn't do it. So most of the time, I'm using the numbers that appear in here. What do we see here? For Schedule L on 2012, there was a decrease to the account due to net losses of the business activities and due to withdrawals and distributions. The current year decrease that you see, $6,113, is calculated as follows. We take line 1 up at the top, $5,502. We then take the total of lines 5, 6, and 7. 5 is 36, 6 is 39, and line 11, $2. Line 6, 5, and 11 do total $77. And then we have line 18. You can see here tax-exempt income and non-deductible expenses. Those are a negative adjustment to his basis. So when we're done that, we've got adjustments to basis or a current year decrease of $6,113. Then I have further comments on Schedule L here. This shows activity within Magic's partner's account, and he begins the year at $86,103. He has a current year decrease of $61.13. He took distributions of $85,009, and then he has an ending basis in his account. Well, that's nice and interesting. Now what? Whenever you sell shares in a PTP, the PTP is supposed to issue you a sales worksheet like this one. So when my clients sell shares, they usually bring in these worksheets, and as I said, my clients who tend to have PTP ownership tend to have ownership in more than one PTP, and I might be filling out several of these worksheets just to do a single tax return. And the instructions for the worksheet say, start with the sales proceeds. Well, the sales proceeds are those numbers that are reported on the 1099B brokerage statement, the gross proceeds from the sale. That's the number that's going to go in this column. And then the original purchase price, well, that would be the amount that Magic originally paid for his stock. And if the brokerage firm is doing its job, they're going to tell him what his original acquisition cost in that stock is. And then adjustments to basis. Well, how do we know what these adjustments to basis are? The partnership has tracked that and is telling us what those adjustments are. So we're just crossing our fingers and hopefully the partnership's got it right, because I don't know any better. My client probably doesn't know any better. And an IRS auditor, they're probably not going to know any better either unless they go audit the partnership or ask to see all of the records that Magic has from going way back in time. Hopefully they would just rely on this schedule here. So what we do is we take sales proceeds, original cost basis, adjustments to basis, total gain or loss. And that would be entered in line 7. So sales proceeds minus the original basis, plus or minus adjustments to basis gives us the total gain or loss. And then we need to take into account this thing here called ordinary gain. Ordinary gain is an amount that Magic is going to need to include on Form 4797, and it's going to be taxed at ordinary income rates, as opposed to capital gain or loss, which is going to carry to Schedule D and get exposed to capital gain rates. And then we have alternative minimum tax adjustment items. If your client is exposed to AMT, you would enter the total of these numbers on Form 6251, line 17. So, good grief. Let's move on and see what happens when we're trying to prepare Magic's tax return. Well, he did receive a brokerage statement, a 1099B from Apex Investments. It's a substitute 1099B. And we can see that it looks like these earlier years are non-covered. So he's not going to have basis necessarily reported to the IRS, but we do look like there could be some that was reported to the IRS. I'm thinking that something's a little bit out of whack here that I'm just now noticing, but we'll go through it the best I can. So we've got the acquired date, we've got the quantity purchased, we've got the cost, we've got the date sold, the quantity sold, and the proceeds less commissions. Magic's realized gain, as shown on the Form 1099B, is $33,583. And how do we get that? Well, we're going to go with the total cost, subtract that from the proceeds, and we're left with this $33,583. And normally, if you were doing a tax return for a client who had a 1099B that they brought into you, you would enter each of these trades on the 8949. It would figure for you a capital gain of $33,583, and you'd stick that on the Schedule D and not think anything of it. But you would have done it wrong. Because it's a PTP, you have to do a lot more work than that. And the next part of the assignment is to come down to this schedule here. And before I was showing you the blank page because that's what the PTP gave to Magic. Magic comes to me as his tax preparer and he gives me this worksheet and I fill it out for him. And on the worksheet, I enter the sales proceeds that appear up here. These numbers right here, except, of course, nicely, the sales proceeds up here do not exactly match the units disposed of down here because some numbers have been batched. So it's even more work than that. I have to go through, figure out what part of these sales up here is split between these different acquisitions and dispositions down here. So when I'm done, I don't have a perfect match of each sales price. You can see these total sales amounts. There are fewer of them than I have sales amounts here. But when I get to the bottom, $129,835, if you were to add all of those up, you'd get that same number. And then we go to the original purchase price on each of those assets or unit purchases, and then we factor in the adjustments to basis that were provided by the PTP to get the total gain or loss. Well, the total gain or loss, according to the PTP, first off is $62,876. That's a whole lot different than $33,583 that you get just by looking at this 1099B. But we're not done. Now we need to figure out what portion of that gain is going to be taxed as ordinary income, and that's $25,168. So we're going to subtract $25,168 from $62,876. And the difference, 37,708, is what's going to be the net capital gain or loss. And this 25,168 is going to carry to Form 4797, and it's going to get it entered in Part 2 on line 10. So adjustments to basis in column 6 show that Magic's gain is actually $62,876, $29,293 more than what is shown on the 1099-B. $25,168 of gain is reported on the 4797 in Part 2, line 10, and $37,708 is reported on Schedule D and on Form 8949. And we've got box B checked, basis is not being reported to the IRS, and what was going through my mind up here a bit is, technically speaking, these transactions that were acquired in 2011, they probably should have been reported to the IRS. They weren't, however. Our problem is going to go through working that they were not reported to IRS. Probably my mind was on simplicity, but I bet you for next year I'm going to have to think that through and probably have some basis reporting, which makes it even more complicated. But we've got the individual sales going on here, and we're showing the net gain or loss from each sale to arrive at that 37,708 that I tell you right here we should get. So 37,708, that's the net capital gain or loss that's going to carry to the Schedule D, and I arrive at that by adjusting the cost basis. I adjust the cost basis to reflect what the partnership says my adjusted basis is, and I don't go with what's on the 1099-B brokerage statement coming to me from the brokerage firm because, well, that statement doesn't account for those adjustments. I have to do that manually. I then carry that 37,708 and the other transaction amounts that are totaled in line 4 down to line 9 of the Schedule D to arrive at the number that's going to carry to my 1040 on line 13. And we have a couple other wacky numbers that have pulled in here from other points on Magic's tax return. So he ends up being $1 more. And 37,709 is going to carry to the 1040. Now it's time to do 4797. And this is a transaction that actually appears in Part 2 of 4797. And I report the amount coming from the K1 on each of these dispositions, and the amount that is going to be treated as ordinary income is $25,168. I enter that on the form, and that will carry to line 14 of Magic's tax return. Also, when you have a disposition of shares in a PTP, the IRS requires a Section Code 751 statement be attached to the return. And it reads, the taxpayer has reported ordinary income upon the disposition of units in NSH Transfer Partners LP as provided by the general partner. The amount was determined in accordance with Internal Revenue Code Section 751. Detailed information is available in the office of the general partner upon request. And we're going to complete Magic's Schedule E, page 2, as shown here. Now remember, at the start of this problem, I told you that he has a carryover loss of $6,044 and a current year loss of $5,502. These amounts are actually going to be allowed in full this year because they are less than the income he's reporting on 4797. $25,168 is being reported as income on 4797. But it wouldn't be fair to make him pay tax on gains that are attributable to losses he was never allowed to claim, would it? So in the year he's reporting this income, he is going to be allowed to claim those prior year losses. And this is more than his carry forward amount, so he has no carry forward anymore. He's just going to start 2013 fresh and clean. So we've got these combined losses totaling $11,546. We are going to be allowed to now enter those as allowed passive losses. On Schedule E, page 2 of Magic's 1040, we're going to type from the PTP and the amount of the allowed loss. We then carry that down to the bottom of the form, and where does this go? It ends up being reported on Form 1040, line 17. And then here is Magic's page 1 of his 1040 coming up. We've got the $36 of interest pulling from the K1, the $39 of dividend pulling from the K1. We have capital gains of $37,710 pulling from the Schedule D. We have $25,168 pulling from the 4797. We have the allowed loss of $11,546. And finally, we get to his adjusted gross income. And that's the only income I gave him. Now, one final note before we close out the day. You have to be careful. When your clients bring in those PTP K1s to you, do take a look at them and see who is actually the owner. Because if you look on a K1 and it says partner's name and address is the IRA custodian, blah, 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 well, that means that the partnership units are actually housed inside of an IRA. They are assets owned by an IRA. And, of course, income inside an IRA is not taxed on the tax return of the person who owns the IRA. So if Magic has interest in NSH Transfer Partners inside his IRA, he wouldn't report that on his tax return anywhere. So it's just kind of a little note. Watch out for who the owner is and make sure you're not reporting IRA income where it doesn't belong. And yes, we are at the end. We're in the last minute, and I finished the lecture. With that, I'm going to continue with a review of the classwork assignment. So looking at the classwork assignment at the back of your student manual, we come up to a character whose name is Sam Techman. He is employed by Chipmaker, Inc., and during the year, he sold RSUs and ESPP shares. The following documents are attached: a copy of Sam's year-end pay stub showing RSU and ESPP awards and options that were added to his income. Also, his USB consolidated 1099 statement showing gross proceeds from sales during the year. A USB advice of sale notice showing the cost basis in the RSUs sold during the year, and 2 USB advice of sale notices for purchases of ESPP shares during the year. Prepare Sam's Schedule D using this information. Well, on this document right here, we have a 1099-B, and it is showing that all of the assets are covered. None of them are non-covered. And the date of sale, the date of acquisition on each of these items, they're all in Chipmaker, Inc. Moving on to the next page. Oh, what's this? It's a pay stub. Well, why would I give you a pay stub? Well, one of the things you need to be worrying about when you have a client who sells shares in an ESPP is understanding the rules about ESPP share ownership. If you're an employee, typically you're allowed to purchase shares through your employee stock purchase plan at a discount. It's usually a 15% discount. So if the stock is trading for $100, you might be allowed to buy it for $15. And if you hold the shares for a minimum period of time, then when you sell the shares, you might realize some capital gain and some wage income. And if you don't hold them for the required period of time, then the difference between the exercise price on the day you buy them and what you actually pay for them is included in your income as wages. And so when you're dealing with ESPPs, at some point you need to be seeing either an advice of exercise notice that shows the cost basis of the shareholder, or you need to be referring to the pay stub to try and find this information. And here we have Sam Techman's pay stub. And what's in it that's interesting? Well, you can see restricted stock unit appearing. That's RSUs. We have quick sale DD, that would be ESPP units that were sold, and we have $2,565 of income that was included in his wage from that. So there's some interesting information on here, which if you're able to match it all up in this classwork assignment, in other words, if you're in a position where you can just take this classwork assignment, read it, and then try and prepare the return all by yourself, what would you make of these information documents? What would you do with them? I'm going to show you what I did with them in a minute, but what would you do with them, and why would you need them? That's the question I'm asking you. Now moving on to the next part of his pay stub, we can see some more information on here. Restricted stock units again, quick sale DD. These are after-tax deductions. What is all of that amounting to? Got to think about that a little. And then I've got this advice of sale. Holy cow, look at all of these. RSU, 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 all the way across. Different transactions. On the next one we have another advice of sale, but this one's for ESPP. Then we have another sale for ESPP. And your job is to prepare a Schedule D and 8949 for that filer. So would you like to see what it all looks like when it's done? I'll pull it up. This answer key, by the way, we do load it in the LMS for you. So if you want to go to the LMS and be able to print this answer key, read through it, and think through it quietly on your own, I find often being put in a situation where I think through a problem myself, I learn a lot more than by listening to someone else rattle on about it. So I'm going to do a job of explaining it all to you. You then have access to the problem itself at the back of your student manual. You have access to the answer key. You can go print that from the LMS and quietly sit and read it on your own time. But I will quickly go through it before we sign off today. So Sam Techman receives a Form 1099-B and therefore must complete Schedule D and Form 8949. The 1099-B shows cost and purchase date information for 2 of the 3 sales. To prepare an accurate 8949 and Schedule D, it is necessary to review Sam's payroll records and advice of sale and exercise notices. Now, there is no standardized method used by employers to report exercise and sale of ESPPs, RSUs, and ISOs. The advice of sale documents provided for this classwork assignment do come from an actual Fortune 500 company, but they will look only like that for that particular company. Any other company out there that is issuing documents of that type is going to have their own format, their own design. But since it's the concept of how to determine basis which is being examined here today, just remember that any actual payroll and advice documents brought to you by a client will look different and may communicate relevant information in a different way. Your job is to learn to decipher all of that and make sense of it. So here we have the UBS financial statement, and I'm just going to point out some of the things that I have to say about it. On this line right here, we have 5/27 of 12, a date of sale, and then we have an acquisition for it of April 16, and then we have the quantity of shares that were exchanged. It's 508. Well, if you're analyzing the documents for this particular sale, you're going to find that when we go look at those advice of sales, that there's two separate RSU advice documents that are being reported as a single transaction. And those include transactions for proceeds of $54.86 on two separate documents. So let's just go find those, and they're right here. So I've highlighted in orange those two separate sales. We've got a 4/16 and a 4/16 sale of RSUs, but we also had three other RSU sales that were earlier or later in the month. And so the only two that we're including to total 508 are these right here. So if you take the 254 and the 254, you add those up, and you get 508. And that totals this quantity right here. So I'm trying to match all of the information my client has brought to me with what's being reported on the 1099B, just to make sure I'm not missing anything. So I want to specifically identify each and every sale and where the cost basis for that sale came from to make sure that I have the correct information. In all cases here, we can see that cost basis has been reported to the IRS. So is there any point in doing all of this work? Well, the answer is yes, there is, because the basis might be wrong. It's my job to really establish that the basis is correct. Let me see if I'm going to find out whether it was correct or not. So the starting point is that the sales proceeds reported here are $10,994. Well, the gross proceeds he actually received from the sale are slightly different. Let's go look at the advice of sale document. Net proceeds that Intel gave to him are reported down here, and when you add those up, you get $10,973.64. The amount shown on the 1099B is different. So we're going to need to make an adjustment for that on the 8949 to account for a difference in the gain on the sale. What's the next thing we can see? Well, on these other items, we've got these three separate sales of RSUs here. We've got 145 units plus 254 units plus another 254 units. If you add up all of those units, you have a cost basis of $15,541. And that gives us a short-term loss, apparently, on the sale. Is that going to be right? Then moving on to the next page, what's this? This is the ESPPs. And on the ESPPs, I'm looking for some very specific stuff. And I'll explain a quick difference between RSUs and ESPPs. These are discussed in detail, again, in our Basis of Assets course. But with ESPPs, there should always be a gross up on a W-2 somewhere that can be identified as a difference between fair market value and exercise price. With RSUs, you would never see a gross up on payroll that's due to a difference of that kind, because when RSUs are awarded, it's an award of the entire value of the stock is gifted to that employee or provided to that employee as a form of payment. And so at the time that employee receives the stock, their pay is grossed up by that amount. So whatever amount their pay was grossed up by is going to be the basis in the stock that they have. With ESPPs, their pay will only be grossed up by the difference in the spread between what they pay for the stock and what it's worth on the date that they exercise it. And so we're looking for that difference here. The purchase price is $16.495, but the fair market value on that same date was $20.775. And so if we do some calculations here, the purchase price is $16.495, sales price or fair market value $27.75. There's a difference between the fair market value and the purchase price of $4.28. If we multiply that $4.28 by the number of units purchased, we end up with $1,831.84. And that $1,831.84, that needs to be added to the employee's pay. And when I go back to the pay stub in a minute, I will show you that that gross up did in fact happen. But I have to do more than one calculation to figure out if the pay stub's correct. So the cost to that employee in those shares is not going to be what they paid. It's going to be what they paid plus what the amount that they were grossed up by. So Sam Texman's cost in these shares is actually $8,891.70. Down here we see the net proceeds from the sale, $8,723.91. Well, how much are we going to report on the 1099B? we can see from the 1099-B that we've got $8,723.91. That's a match to the advice of sale document. The sales proceeds up here are $87.41. That was what was reported on the 1099-B, but the amount that he actually gets is $87.2391. So he's gotten less because a brokerage commission was held out. So now we have another adjustment. In other words, the 1099-B is showing an amount that's incorrect, and it's going to be off by $20. We then come down to the next advice of sale. It's for another set of ESPP shares. And in this case, we look at the purchase price and the difference in the fair market value. If you subtract out that difference, you get $2.845. You multiply that by 258 shares, you get $734.01. You add that to the amount that he paid for those units, and you end up with $4,894.26 as being his basis. If we look at the sheer math here, we know that he has a loss of $82. That is what he paid for it, $48.94 from what he received. So this is what he received, net proceeds. This is what he paid. And we have a loss of $82. On the earlier ESPP, it's telling you this is what he sold it for, and this is what he received, and this is what he sold it for. And so we have, again, another difference that's going to be a loss. It's normal on the sale of these ESPPs to have a slight loss. It's possible to have a profit if there's a lot of fluctuation in the market where you exercise in the morning and by the time you sell in the afternoon, the stock can jump in price. It is possible to have a gain, but it's unusual. So let's go back and think about the information I just showed you in relation to the pay stub for Sam. By examining the advice of sale, we have determined that his cost basis that he should have in his ESPPs. Payroll laws treat the discounted price of ESPP shares sold to employees as a taxable benefit, and the employer should therefore report the difference between what that employee pays for shares and the fair market value of the shares as employee wages. And by examining Sam's pay stub, we do see that he does have an amount. And if you look at it, that amount is reported right there. And if we look at those two transactions on those two advice of sales, I told you that the spread that should be included in his income was $1,831. And on the second one, the spread that should be included in his income is $734. When I go over his pay stub for the year end, that's exactly the number that they included in his payroll. So I'm spot on. So there's nothing that came to me in the form of a tax document issued by the brokerage firm or a document issued by the employer that summarizes all of this perfectly. It's my job to really take all of the different sources of information and see if I have a match the way that I think I should, and in this case, it matches perfectly. But this is a little confusing here, this restricted stock unit or RSU. The difference with RSUs is that if you are gifted stock by your employer is going to gross up your payroll by the amount of stock you received, and then you're left holding this stock. And you might not sell it for a period of time. You might not sell it until well after the year that it was included in your income. So all that we know when we look at the RSU on this pay stub is that RSUs were awarded to him and the value of those were included in his income. But there's no way for me to know, looking at this pay stub, whether or not any of this income is attributable to RSUs that he sold during the year. I am solely left with the advice of sale documents and the 1099-B brokerage statement, and I have to rely on those. There's no cross-match that I can do with the pay stub. Take a look at the tax return that you need to prepare for Sam Techman. And what I would like you specifically to do, take a look at the individual sales being reported on his 1099-B. And there's two specific sales, the 508 shares of chipmaker stock and the 258 shares of chipmaker stock sale. Both of those stock sales are going to need to have an adjustment code of B entered in column F of the form 8949 for Sam. And what I would like you to do is figure out what that adjustment amount will be that you will then enter in column G. So what amount would you enter in column G for the 508 shares of chipmaker, and what amount would you enter in column G for the 258 shares of chipmaker? All right, so here we have an 8949. So we take a look at each of these individual transactions, and I've created a color-coded box to match. And the first transaction I've reported is just in the order that they were appearing on the 1099B, as I recall. We've got 508 units that were sold in the RSUs, and that was actually, if you go look at the advice of sale document, there were a total of 5 RSU sales described. 3 of them were sold off on one batch, and 2 of them were sold off on another batch, and this is the batch of 2 that totaled 508. And the amount that we know was a cost to Sam is the amount shown on the advice of exercise, and that's $12,174.22. And that is actually a match to what's on the 1099B. It is correct. We then look at the net proceeds received by Sam. And the proceeds received by Sam, according to his advice of sale, are $10,973.64. But the amount shown on the 1099B is $20 higher than that, and that's because a brokerage fee was held out. So to the extent that we have a difference there, we're going to enter a code B and describe that $20 reduction that will reduce the capital gains. So the brokerage statement was showing an $1,180 loss when in fact the loss is $1,200 because we have a negative entry there. Then moving on to the next transaction in line in the peachy color, we have 258 ESPP shares. Those from the advice of sale, we rounded out and figured that there's a short-term loss of $82. The brokerage statement shows $4,812 and $4,822 respectively as the proceeds and cost. But we know that that's wrong because we need to end up with a net loss of $82 based on the figuring on the advice of sale document. And therefore, we're going to enter negative 72 as a correction in column G. Then we have 428 shares of ESPP, and those are a perfect match. The amount shown on the advice of sale and the amount shown on the 1099B statement are exactly matching. They arrive at a $168 loss, so we don't do anything other than copy the information directly over from the 1099B. And then finally, we have the 653 units of RSU shares that were sold, and those have a cost basis of $15,541. That is a match to what was reported on the 1099B, but then we also have a perfect match on the sales proceeds as well. So the amount on the 1099B and the amount on the advice of sale for both of those is exactly the same, and therefore there is no change in that column either. So that concludes the review of the classwork answer key. How do you print the answer keys out? I'd be happy to show you that. You need to navigate to the LMS. Have you found the point in the LMS where you printed the manual? Well, the answer key is in the same place. You just scroll down the page and it'll show you the answer key for the classwork. Ultimately, there would be a homework answer key there as well. But yeah, that's where we put the answer keys. I see your question, how is the holding period for qualified dividends calculated for an estate that receives the decedent's stock? Well, a holding period for inherited property is always long term. I suppose it's possible that the decedent could have bought stock and then immediately died, and then dividends were issued within the 60 days. It's theoretically possible, but even if it were to happen, it probably would still be allowed because it's all considered to be long-term. That's nothing I've ever had to look up or think about, frankly. But yes, stock that you inherit is always considered to be long-term. I haven't ever read anything that talks about treatment for qualified dividends and whether there's a difference there, but I can't imagine that the IRS would even be bothered going into that. If they did, it might be in the instructions somewhere for figuring how much of a qualified dividend you have. I've read the instructions and I've just never seen it even mention that. Now, if the estate inherits money and then uses that money to purchase new stock, and then immediately after purchasing the stock, then it generates dividends, then you could be dealing with that. But I don't know that it's anything to deal with if it's outright inherited stock within 60 days of the person dying. And after completion of the classwork assignment, there is a homework assignment for Diana Prince. It is one of the most evil assignments I've ever created, according to the students who take my classes. And for Diana Prince, you would need to prepare a tax return that includes a 1040, a Schedule A, a Schedule D, an E, a 4797, the Schedule D tax worksheet, and the Unrecaptured Section 1250 gain worksheet. When you complete the assignment, you can access the answer key to it inside the Learning Management System underneath the Materials page. You need to pass the assignment before you can have access to the answer key. And to go take the password test, you're going to need to enter the 4 passwords I gave to you. You then need to scroll to the bottom of the screen where you enter the passwords and be sure to click Submit to submit the answers into the system. If you don't submit the answers, then the system doesn't give you a score. And if it doesn't give you a score, you can't pass the test. But once you have submitted your answers and passed the test, You should see a green status bar floating at the top of your page, and when you have successfully completed the password test, that status bar should guide you to the certificate of completion. The certificate of completion does fall underneath a survey, so it'll land you on a page that is the certificate of completion page, but NASBA, the National Association of the State Board of Accountancy, requires that we give you a survey, so we stick it there. And you can take the survey if you like, or just skip past it, and then underneath it is the certificate of completion link. So that concludes Pacific Northwest Tax School's presentation of sale of assets. I hope you enjoyed the class and look forward to seeing you again soon. Bye-bye.
Yellowstone, YELLOWSTONE. Yellowstone.